Okay, great. And everyone's good. I'm going to admit everyone now.
Okay, and I'm going to start.
Yep.
Cool. Hi, everyone. Welcome to today's tax workshop. It's an annual workshop that we do here at X-Space Cultural Center. We love doing it every year. We know that it's an incredibly important time for a workshop like this to be happening. So thank you for joining us today. We're all not currently at the gallery, but we're all in our separate homes. And speaking of where we are, while we may be located in different spaces with X-Space events, we usually begin with a land acknowledgement to give more context to the Indigenous land in which the gallery operates on, as well as to function as an understanding of the land and our relationship to it, both as individual arts practitioners and cultural workers living and working within Takaranto, as well as the collective entity that constitutes X-Space. So this land has been a site of human activity for 15,000 years, serving as the home of Indigenous people and nations long before the colonial project. These are the original territories of the Huron-Wendat, the Anishinaabe Nation, the Haudenosaunee Confederacy, the Mississaugas of the Credit First Nations, and the Métis Nation. This territory exists in the One Dish, One Spoon Wampum Belt, a peace treaty and mutual agreement established between the Iroquois Confederacy and the Confederacy of the Ojibwe and allied nations to care for the land and the precious resources around the Great Lakes. The dish representing, this is the dish, it represents the land itself, and the spoon representing responsibility in sharing its resources, never taking more than you need and sharing with others. We must continue to uphold this treaty, both as Indigenous folks and addresses and informs the entirety of our relations and relationships. For us at X-Space, this treaty informs our intention to support artists who exists on the margins through public programming and the sharing of additional resources for arts practitioners. For us, it's about a sharing of knowledge, hospitality, and opportunity, and we love to see our fellow peers gathered across the vibrant arts community that has since developed here. We stand in solidarity with Indigenous communities against the violent forces and effects of colonialism, and we wish for this land acknowledgement to also function as a call to action. Dismantling systemic racism and white supremacy within the institutions and systems that we exist within daily, as well as continuing to fight for Indigenous sovereignty, rights, and stewardship of land, are just a few of the many forms in which support can take. We seek to use the resources available to us as an art space in order to work towards these goals within our projects and within our programming. And as we see land acknowledgements rapidly become automated and co-opted by institutions, we recognize the inherent failure of the land acknowledgements itself. But despite these limitations and intrinsic failings, in still including it, we would like to honor the land acknowledgement as something that is alive and ever shifting, unable to be completed. For us, it's a process of change as we commit to always be reflecting, responding, and learning about what it means to live and work on stolen land. Even before everyone was admitted to this meeting, we were just talking about how now would be a lovely time for X-Space to even redo this current one that I'm reading right now. So it's always a work in progress. And in regards to my own specific context, as your host, I am the son of immigrant parents who moved to Canada from the Philippines in 1989, 6 years before I was born. Cultivating new beginnings from the ground up in a new place means that my family, countless other immigrant families and members of the Filipino diaspora specifically hold our new homes with a special kind of reverence. But despite these perceived ownership of land and the complexities of the immigrant experience, my family, has always been guests here, and the land has never been truly ours. And I don't think this is talked enough about in immigrant communities. And I didn't realize this much later in my life, and likewise didn't think it was ever really made apparent to my parents either. And I've been trying to unweave these embodied misunderstandings in effort to better understand my place on this land as an artist, as a curator, as someone who works at X-Space, and just as a general human being. And we encourage you to think about your unique relationship to it as well. So just a little bit about X-Space if you're new here. with the tax workshop, we get a lot of repeat customers, but also some folks who are joining us for the first time. So founded in 2004, X-Space Cultural Center is an artist-run center located at the intersection of Lansdowne and Dundas, mandated towards supporting the professional development of emerging artists, designers, curators, writers, and other creatives in the city of Toronto. Among the ways in which X-Space does so include: one, showing work by emerging arts practitioners across our 4 exhibition spaces, through which the entirety of our programming year is selected through an annual call for submissions. Hot tip, the 23-24 call is set to launch in early April, so that's not too far away, so keep your eyes peeled for that. 2, we commission essays from emerging writers to accompany all of our exhibitions. 3, we host free workshops, events, and other public programming that range from really practical things like tenants' rights workshops to tax workshops, to really fun and leisurely workshops like DJing or tarot card reading. So if you have an idea for a workshop or a skill that you want to share, we'll also be launching a call for workshop proposals alongside our annual call in April. And finally, we commission posters for all of these workshops and events from emerging illustrators and graphic designers. We don't identify emerging as by age or number of years out of school, and we often show artists who have never shown before. So it's never too late or too early to get involved with X-Space. And we are interested in fighting the perceived notion that artists do not need to be paid or are paid in quote unquote exposure. Meaning that X-Space commits to equitable for labor. So all opportunities with X-Space are paid. And we also have a very active social media presence in which we share paid opportunities for artists, calls for submissions, or free or pay what you can workshops and events in the city that span beyond what we're doing in the gallery. Toronto and Ontario, honestly, the scene is really rich and there's so much going on. So we're constantly sharing opportunities to our Facebook group and to our Instagram stories. And we encourage you to check it out because there's always new things being posted there every day. And it's a fantastic resource. I do realize that I'm throwing a lot of information at you. So if you have any questions about how to get involved with X-Space or about any specific things I said during this brief introduction, you can always email me at philip@xspace.info. Thank you, Nat, for putting that in the chat. Yeah, feel free to let me know if you have any questions. Currently on view at the gallery right now is our recently opened round of spring exhibitions. We have a window space exhibition by Wenting Lee. We have a group exhibition curated by our dear new director, Avalon Mott. We have a video work in our external space by Maddie Lychek and a solo show by Toronto-based artist Jill Smith in our project space. So always lots going on at the gallery. We would love to see you. Yeah. And I'm almost done, I promise.
Yeah, I'm just going to hop in quickly to say there will be a Q&A portion at the end of this workshop. So if you have any questions, feel free to put them in the chat and we're going to address them around 4:15. So we're going to compile them all and we will be asking Kelly your questions. Sorry to interrupt you, Phil.
No, that's great. I was just about to mention that too. I guess just to quickly tack on to what you're saying, Matt, when it comes time for the Q&A section, I always feel like it's good to just mention some quick accessibility things that you might want to consider as you unmute yourselves and speak. If you could maybe just say your name before you're called to speak, that would be amazing. And if you could maybe move closer to your mic just to ensure that everyone in the meeting can hear you, that would be absolutely lovely. Now that housekeeping's out of the way, I'm going to go ahead and introduce our dear Kelly Ross, who is facilitating today's workshop. So Kelly Ross is the Managing Director and CEO of Ross Professional Corporation. She is a member of the CPA Canada Leading with strength, knowledge, and passion, having over 20 years of experience in accounting and taxation. Though through her career, she's worked in a multinational CPA firm, then moved on to be a subject matter expert for development of an accounting program at a college. Kelly's interest and passion for accounting came from her mother, whose career was in the accounting realm as well. Kelly has a love for artists and entertainment industry, which stemmed from having a father who had a talent and love for music. Kelly herself also played piano, trumpet, and was a dancer through her early years. Now, in her downtime, Kelly can be found around the hockey rink supporting her daughter's hockey team and following her nephews in their live band performances. She is truly a people person and has a special skill making everybody she meets feel special. And I personally loved reading that bio. It's so sweet. And honestly, from this point on, I'm just going to let you take it away, Kelly. Thank you very much.
You're welcome. Thank you so much for having me. It's a pleasure to be here. I do, as you mentioned in my bio there, I do have a very much soft spot for artists, having been around it all of my life. And I'm very lucky that I'm able to, even though I'm in the accounting realm of doing things, be able to service a lot of people within the arts and entertainment industry. So it allows me to enjoy both worlds at all times, which is wonderful. Not everyone can say that, so I feel very lucky. So hopefully today you guys can all learn a lot of great stuff, and please do feel free to ask all the questions you want at the end. I'm happy to bring any clarity to anything for you. And even if there's something I haven't spoken about that you're interested in, I'm happy to talk about that as well. So let's get into what we're going to talk about today. So here's a bit of an agenda to go through the different stuff we're going to talk about. I'm going to talk about the difference between employment income and self-employment income. And the differences on the way you report that and your obligations as far as the government goes. Self-employment expenses, I'm going to try and give you as many tips as I can. Being artists, there are some things very specific to your industry that you can deduct for tax purposes. Sometimes you might find yourself in a position where you even have to educate the CRA agents in respect to that. And I'll tell you how to go ahead and justify that to them. We'll talk about some filing deadlines, RSPs and TFSAs and how you can utilize those to your benefit for tax purposes. I'm also going to talk about some new measures that have come out by the government this year. I find the government's not very great at making sure everybody's fully up to speed on the stuff coming down the pipeline. So I just want to make sure you guys are all aware and can get the deductions that you need to help you out with your tax situations, as well as making sure that you don't find yourselves getting penalized for anything without realizing that it was something you needed to do. HST is another area I find a lot of people need some clarity around, so I'll explain when and when not to charge HST. And I'll also give you some hints around CRA audits. I know they can be scary, so I hope I can take that fear away from there and tell you you'll be just fine and how to get through that on the other side. So first, let's chat a little bit about employment versus self-employment and the differences. Really, these two pictures really do say it all as far as when you might find yourself in one situation versus the other. Mind you, a lot of times in your industry, you do have a choice, and it might also have something to do with whether or not you're considered in front of the camera versus behind the camera when it comes to different things that you're doing. So on the left side is your typical employees. So these are like your pilots, your people who work in the office, your doctors, your lawyers, pretty much most industries that are out there. A lot of people are getting your T4 income. You just get your paycheck at the end of the week or bi-weekly or monthly or whatever increments they have set up for you. You don't really worry about much of anything because they just take the taxes off the top. When you file your tax returns, you hope they did it right. And if anything, you get a tax refund as opposed to having to pay anything. Now, when you're self-employed, that's where it becomes a little bit different because now there's nobody doing all of that stuff for you behind the scenes. Nobody's withholding any tax dollars for you. This is all stuff you're going to have to do yourself. And unfortunately, that also means you're going to have a lot more tracking to do. So there's a lot of different things that come into play when CRA might be looking at whether you're really having an employment relationship or a self-employed relationship. And one of the biggest ones is your risk of profit and loss. As an employee, you tend to walk into things with a contract. You know exactly the duration you're going to be working. You know exactly how much you're going to make. You really have no risk involved in this time frame that you're contracted. You know exactly what's coming, and you don't have to worry about remitting anything. They do all of that for you. With respect to self-employment, each contract that's worked could result in possibly spending more money than you receive, because maybe you've had to go and incur some expenses in order to generate that income. And The government does take that into account. So when you're filing your taxes, there's a lot more things you can deduct with respect to that employment income that you're receiving to be able to deduct to not have to pay as much tax. So we'll go through all of those deductions a little bit later. Substitution is another topic. As an employee, you're contracted, you the person, so you can't really bring people in to replace you or to step in to help you out with some of those duties that you're doing. On a self-employment side, this is where you might actually have some options. Unless you've been given a contract that specifically says nobody else can be involved in any of the work you're performing. So a lot of times what you can do is have somebody in there just to help you with a lot of the extra stuff. So when you find yourself in a higher income area where maybe there's some extra cash around, and you can have somebody doing a lot of the administrative stuff, anything that doesn't require your face on it, this is where you could potentially have some other help, or you could also subcontract somebody to come in and help you out. So as I started to get into a minute ago, when it comes to the difference in the contracts, it's really important to understand that as an employee, the CPP contributions, which is your Canada Pension Plan. So this is a plan that you can pull down from when you were older and you're at retirement age, and the government's going to be issuing you a check. It's not a lot. So don't be thinking you're going to have all this money to go and retire on in the end there. But it's enough that they think that between that and what's called their old age security, between the two, it should be enough for you to at least live off of and feed yourself. Employment insurance is the other thing that will be withheld as well on your paychecks. And this is in the case that you no longer have any income coming in and you're not employed anymore. You might be able to go and apply for some of these benefits, or if you're going on to a maternity leave because you're going to have a child or something along those lines, or paternity leave for the father as well. And personal income tax. So the amount related to tax is being withheld by the employer as well. And then they are remitting all three of these items to the government for you on a regular basis, on a monthly basis. Now, if you're a self-employed individual, unfortunately, that's not something that's going to be done for you. This is something that you're going to have to make sure you're putting money aside for as the year goes on. So it's payable at the end of the year or possibly quarterly if CRA has ever sent you a notice with respect to having to make installment payments or other types of payments throughout the year. Like even if when it comes to HST side of things, they might want them more regularly. And a lot of times that's all based on the amount that you're having to pay, and also the amount, the frequency in which you've been paying. So if you've been late all the time, they might start wanting you to pay more often to make sure that they're going to get their money. Now, as you're self-employed, it's very important to not forget that you need to issue an invoice for your services. Your name, your mailing address, your phone number, the date, that's something that gets forgotten a lot. Make sure you date your invoices. You're going to list your description of services. So this would all be based on why you've been contracted, the fees and the cost. And if you're HST registered, this is where you would also include an HST component to it. And if you are HST registered, you want to make sure your HST number is listed on that invoice somewhere as well, because the person paying this invoice, in order for them to get a deduction on the HST side of things, an HST number must be present on this invoice. And similarly, if you're ever paying anything with HST, you'll want to make sure that any invoices anybody's giving you has the HST number on there as well. Now, when it comes to your contracts, again, being employee or self-employed, bookkeeping, as I mentioned, it's very minimal when you're an employee. There's not much you have to do. A lot of it is all being done for you by the employer. As a self-employed person, this is where you're going to have to do a lot of tracking. You need to make sure you understand all of the income that's coming in, all of your revenue, and all of the expenses that you're incurring with respect to incurring that revenue. So we'll go through all the different expense types that are in there, and I'm pretty sure you're going to find quite a few in there you might not have thought about before. And it's really important to make sure you're capturing all of those things so you can keep more money in your own pockets. Now, as an employee, you'll be issued a T4 slip. If you're self-employed, you might be issued a T4A. You really should be by anybody you're working for, but I gotta say, from being in the industry, I know that doesn't happen a lot of the times. So just make sure that you're tracking your revenue yourself. And if you are issued a T4A from anyone, make sure it matches the numbers you have, and you're questioning if that number does not match. Because that is really what the government is going to be seeing from them issuing it on their side. And you want to make sure that they're not putting a higher number than you actually did make in those years. Your filing deadlines, if you're an employee, your personal income tax return would be due on April 30th. Now, as a self-employed person, while this is considered business income, this business income would be reported on your personal tax return unless you've incorporated yourself. So if you haven't done an incorporation, you're generating a sole proprietor business, and you would report that on what's called the T2125 schedule of your personal tax return. Now, because you would have self-employment income, you would now have a filing deadline of June 15th. But one thing that's very important is that while they do give you a longer time to pull all of your stuff together, they do still want all of your money by April 30th. So one might say, well, how am I supposed to do that? If it's not due till June 15th, how am I going to know the numbers? Well, it's true, you may not. But what they want is for you to at least make an estimated payment. And my suggestion is to overpay if you can, and just get the refund when you go to actually file your return on June 15th. Or even better, file it by April 30th, and then you don't have to worry about it because it's the actual number. So sometimes you get a decision on whether or not to choose to be an employee in some of the work that you're doing, or whether to be self-employed. And I get asked this question a lot as to which one is better. And I always say, you know what, if I were to talk to you just from an accountant's point of view, and looking at just the tax side of things, I'm always going to tell you self-employed is better. But there's other things to consider and to take into consideration. Like, you're going to have to be very organized to be self-employed and to be able to take all those deductions that you have in there, as opposed to the employee side where you don't have to think about a lot of it. But at the end of the day, there's going to be a lot more money in your pocket because you're going to be able to deduct all these extra expenses. So it's something that you have to make a decision on, but just know from a money standpoint, you end up in a better place from the self-employee side. You also get a lot more control over the different things that you do. As a self-employed individual, you can make more of the choices than you can as an employee. With an employee relationship, there tends to be also that expectation that they're going to be telling you everything that you need to do at every point in time. Whereas a self-employed individual, while there are some guidelines that you need to follow for different work that you're doing, you also still have a lot of control in the way that you are conducting yourself and doing different business. It also may give you the opportunity to earn additional sets of income that you might have been restricted on if you went into an employee-related relationship. So as we talked about before with taxes, that it's being withheld if you're in the employment situation as opposed to being self-employed. But what we haven't spoken about is insurance. So when it comes to the EI related stuff that we were talking about before for employment insurance, and if you get laid off, you can go and apply for these benefits. As a self-employed individual, this is not something that's available to you. And the reason it's not available to you is because they say you're in control of the income that you're having. Because as a self-employed individual, you can go out and choose to go and get more work, to get more contracts, to always be working on the next contract while you're still in the current contract. And that's not something you can do as an employee. And for that reason, they say, no, you can't get the employment insurance. So that is something that you need to consider. And I have seen that come up quite a bit, especially when people are thinking about things like the maternity or paternity leave. They don't realize later on that they may not be able to get those benefits. So it's just important to understand that different side of things, because you are the one who does control your income when you're self-employed. Now, mind you, there are situations in life where you can't fully control it, like things like natural disasters that are going on, the COVID whole type of thing where things were shut down and you can't control that. But that's when there's other types of measures that the government is supposedly stepping in for to help out individuals for. Now, one thing that's important too is consistency. You got to think about the consistency of things when it comes to being an employee versus self-employed. As an employee, things are very consistent. You follow the contract, you know what's coming. As a self-employed individual, you really are streamlining that. So just remember that if you're not working on getting more income coming in and trying to get all those additional contracts, this is where your income is going to stagnate. And you need to be aware of that and ensure that you're constantly thinking about what's the next contract that's going to come in, where's the next set of income going to come in. So there is a bit of stress when it comes to that. Now this slide here, as we start to get into self-employment expenses and start to get into the stuff of how you can save money, there's really 3 R's that I want you to think about. First, is it receipted? Second, is it reasonable in nature? And 3, is it related to your revenue generation? And if you can put a check mark next to all 3 of these things, then chances are you can deduct this for tax purposes. So while we will go through a full detailed list on various types of expenses that you can deduct, still come back to this, because if it's not on the list and you can say yes to these, then you can justify why you should be able to deduct those various expenses within reason and within some tax rules, of course. But really, those are the most important things. Make sure you have that physical proof. That's the receipted part of things. So always keep those. Put them aside. If you're a person who doesn't want to keep paper, that's okay too. But make sure you take a picture of it or you scan it so you have a copy of it somewhere. So in case later on down the road you were to get audited, you have some proof on that. Really, really important, especially when it comes to the HST side of things, because they do want to see different receipts. On the income tax side of things, you might get a little more leeway and be able to justify various things other ways, but the receipts are super important on the HST side. Now, the next thing is it reasonable in nature? So think about the income that you are producing, and think about the expense of what it is that you're buying. Was it reasonable to consider the fact that, you know what, I purchased this for this amount of money, and let's say this was $1,500 I paid for something, but I really could have gone next door and got it for $500. So the question is, can you justify why you paid $1,500 for it versus $500 for it, right? So reasonable from that side of things, or is it reasonable that you've done so much of this incurring of expenses for the amount of income that you had? So why would you go out and spend $20,000 on expenses and stuff related to this revenue generation when you're only bringing in $5,000 of income? Doesn't mean you can't do it. It just means you have to make sure that you can justify it and explain why that was a reasonable thing. And the reasonability related to that could be the future income that's going to come. So I needed to incur all of these expenses up front in order for me to go after this type of business, which could generate a whole bunch of other money. So it's okay as long as you can justify it. And then just make sure it's related to that revenue generation. So let's talk about some of the self-employment expenses that you can actually take deductions for. So if you belong to any associations or any unions or any clubs related to any of the groups that you're doing or any of the work that you're doing with like-minded people, those would all be deductible for you. How about an agent? Maybe you've gotten an agent at some point in time, or you have like a business manager who's helping you out. All of those fees you can deduct. Your telephone. So this could be if you still have a physical landline at home. I know many homes don't have them anymore, but if you do, it could be potentially for that if that's a business-only phone, or if it's used for business purposes, then there's a percentage that you can relate to it for a deduction. Same thing with a cell phone. So maybe you use your cell phone for all your business-related calls. So it's important to kind of figure out how much of that is being used for business and how much is being used for personal. And then you can go and take a percentage of that. So let's say, you know what, my cell phone, I use 75% for business-related activity. Well, let's say that cell phone cost you $1,000 a year to have the plans for. Well, now $750 of that you can deduct on your tax returns as a viable expense against that income that you're generating. How about advertising and promotion? What are you doing in order to get yourself out there and get yourself known? Have you ever put a posting in a newspaper, on some digital board somewhere, or maybe you've paid to sponsor something in order for your name to show up there, or maybe you've attended something, some sort of event or some sort of, I don't know, even something like this, but not on taxes, obviously, that's servicing you, but it's going to get you in a room potentially with other like-minded individuals that could potentially bring you future business. So this would all be deductions that you can do. The one thing to keep in mind is if it has anything to do with food, so any meals and entertainment related stuff, it's only getting a 50% deduction for that. And that's just a standard rule across the board that the government has, because they're saying that you're getting some personal benefit for that. And this rule of 50%, it doesn't matter whether there's just you who's having to spend it or whether it's 10 people who are having to spend it, it's still only 50% of that total bill that you can deduct. Now, let's say for any of the work that you're actually out there performing, or whether it be for anything that you're doing for promo purposes even, let's say you've had to have an accompanist, some coaching classes related to that, or any other types of professional development, that can all be deducted too. How about any music or downloads that you're doing, any scripts, any books, any of that stuff that you're purchasing? Just keep in mind, it's not 100% value if this is the only stuff that you've ever purchased all year long. You want to make sure you're putting in a personal piece of that you're contributing to that. So when I talk about the music, for example, if you have an Apple Music subscription, I'm saying don't go and take a deduction for the full value of that amount. There's got to be a personal portion that they'll fight you on for it, to say that you listen to music sometimes personally, unless you can somehow justify that you have two separate subscriptions and your music for business purposes is only done on this one device and that's the only place it's downloaded on and not this other device, and you don't share it in a family plan, for example, things like that. So you would do the same kind of ratio when it comes to deducting that as you did for the phone, like I had used the example for the cell phone. So you take a percentage and you can do a deduction for that too. Office supplies, don't forget the little things. So even just here, I've got a sticky notepad. So that's a deduction. Any pens that I may be buying, maybe a notebook that I use to take down notes on anything. Any of those types of things that you're doing, make sure you're deducting them as well. Maybe you are subscribed to any professional publications of any sort, or maybe you've had to purchase a business wardrobe and maintenance. But be very careful with this one because this one does get challenged a lot. It has to be very specific to your revenue generation. And it doesn't mean your everyday clothes that you're going to be out using to even try and go and generate business. This is your stuff that is used for your specific revenue production on a day. Okay, so you have to be in a specific outfit. You have to be maybe in the next line item on here, the stage makeup and hair. Maybe you had to have your hair a certain way in order for something to work. So maybe it's something very specific that you needed to have your hair even a certain color or something to go with the whole line of the way things are going. Well, then that would be deductions for you. But just make sure you're not ever trying to deduct any expenses in these two categories in a time frame where you weren't actually conducting any work and generating any revenue and there wasn't any in-person types of events, because this is where you're going to run into some trouble to be able to justify it. So always just remember that one of those R's in there about it being reasonable. Well, make sure you're being reasonable in this area, okay? Accounting and legal, so maybe you've hired an accountant or a lawyer at some point to review some contracts, for example. That would all be deductible for you. Equipment, so maybe you've had to purchase something in order to conduct your business of some point. This could even be like a special tool that you need, or it could even be some special lighting that you're purchasing. That's all deductible for you as well. Just keep in mind that any of the equipment that's over $500, you don't get a full deduction for in the current year that you purchase it. It's over a multitude of years. It's what we called amortizing. So you would amortize that piece of equipment over multiple years, and it depends on what it is specifically as to how many years that may be. And it's usually judged in the category based on what's considered its useful life. So while you may buy, for example, let me think. So let's just say any piece of equipment, but then let's say it's going to last you and you can use it year over year over year, over 5 years potentially. So over 5 years, you might get that deduction. But CRA does have a very comprehensive list that you can always refer to if you're ever not sure. If you just Google CRA CCA classes, then you can go and find all the different categories and it tells you the percentage that gets deductible each year. Also, office or studio rental. This is one where you can really get a lot of deductions in here. So let's say you don't rent a studio at any point in time for any use, but you do a lot of your business work at home. So let's say you have a set aside space in your home. Let's say you happen to be in a 3-bedroom home and 1 bedroom is segregated and separated just for a home office setup for you to be able to conduct this work. Well, you've got to figure out what square footage are you using for that office. So let's say it turns out to be, I'm just going to use round numbers here, 100 square feet of that room, and the entire space you have, sorry about that, I think someone was trying to call me. The entire space you have is 1,000. So now we're at 10% value, right? So we're taking 10% of the space. So this means all of the expenses related to running that home is now deductible at 10% rate. So this includes your heat, your gas, your electricity, your water bills. If you have a mortgage on the property, the mortgage interest, so not the principal payments. So even though you may be paying a large payment of, let's say, $2,000 a month towards your mortgage, only the interest piece of that. So let's say the interest is $1,200, then that would be great, because then you can deduct the $1,200 portion, but the $800 you can't. So you would take 10% of that is what you would get the value for, and that's for all the months of the year. So it can really add up. Same thing with property tax, same idea. You get that deduction for that piece as well. So as well, even the phone, right? Because when I was talking about the telephone earlier too, maybe you had a landline as well in addition to the cell phone, or I know some people now have actual cell phones that are the landline themselves that they're using. So that's something to keep in mind too. So that would all be at that same rate that you're going to take that deduction for. Now, let's say you don't own, but you rent. Okay, so for renting purposes, you're going to have the same kind of idea. You may not have all the same expenses. You may not have that mortgage interest. You may not have that property tax, for example, and maybe even some of those utilities you're not paying for because maybe you're renting in a condo, for example, but you're still going to have rent. So there's a percentage of your rent expense that you're doing every month that you're going to be able to take that deduction for. And if there's any condo fees, for example, there's a percentage for that as well. So as you're starting to see, this is really, really adding up, and it can be very significant. Now, the difference between this deduction and the rest of the deductions we've been talking about is the government does limit you to only the amount of income that you've made in the year to be able to take to home office deductions for. So you can't put yourself in a loss position using home office, but you can definitely keep offsetting your income. Now, you may say, okay, well, I know this is going to put me in a loss situation, so I'm not even going to bother trying to add this stuff up. It's not worth it. Well, the answer is yes, it is still worth it. And the reason is because your future income, you can carry forward this home office expense to use in future years. So still tabulate it all, still add it all up, still throw the numbers in. Whatever you don't use in the current year, you can carry forward to the next year and be able to use that as well. So let's talk about now, we're done with your home and your office that's there, but what about your transportation that you're doing? So think about all the different transportation that you're doing in order to generate this revenue. Maybe you're jumping in Ubers, maybe you're jumping on the subway, maybe you're jumping on the streetcar. Well, every time you do any one of these things, make sure you're keeping your receipt and you can deduct all of that as well. Now, what if you say, well, I don't take public transit. I have my own car and I drive my own car. Well, we account for that too. So what you would have to do in this situation is track your mileage. I know it sounds like a lot, and it is if you're doing it manually, but there are a lot of things out there that can help you kind of track that. There's a whole bunch of different apps out there. I use one myself personally. And if you do any of your bookkeeping in any of the online softwares, a lot of them will even link together and upload all that information for you, which is great. But it's really easy. So in those apps, for example, if every time you're sitting in a car and driving, it recognizes that you're in a car and you either swipe right for personal, swipe left for business. I can't remember which way it is, but it's one or the other that you're doing every time you're in there, and it'll send you a report monthly for that. Now, if you don't want to use the apps, then you just have to make your notations and track where you're driving back and forth. Because what you need to do from this is then take a percentage of your business travel versus the travel that you've done mileage-wise on the entire vehicle for the year. So it's really important that you're tracking all that stuff, because now you're using that percentage against all the expenses related to that vehicle for the year. So we're not talking about tracking just when you filled up your car because you were going to go and drive to a location. Well, obviously that tank isn't going to be used full from beginning to end for this one related thing. So we do it through the mileage. But keep a handle of every one of your receipts related to that vehicle. So this is every time you put gas in your car, every time you go for an oil change, maybe you've taken it into the mechanic because there's been issues with the car. Don't forget registration. So when you've gone to renew, when you renew plates, when you renew stickers, when you renew your license, any of those different aspects, you're going to take a percentage of that too. Okay. Your insurance related to the vehicle. So it's again a lot. You'd be surprised how much of a deduction you can end up on this one as well. So definitely worth the work of tracking it in order to get those deductions. Now, what about if you have to go out of town related to anything? Well, again, think about what it is that you're having expenses for that you wouldn't have had you been at home and been able to go home and eat, go home and sleep. So here's your hotels, it could be your food. But again, be reasonable, right? Reasonable is really what it all comes down to. Make sure that you have a reason and justification for all the different aspects of what you do. And there are per diem rates that the government comes out with all the time on a regular basis of what they consider to be reasonable. You can use the actual receipts, or even if you were to choose, because you're going to be out of town for a duration of time, to go out and go grocery shopping, for example, there's per diem rates related to that to account for repaying you for that aspect. If you had plane tickets, train tickets, all of that would be included in your out of town travel as well. So let's say now you've gone out and done some photographs, or you've gotten some resumes or bios done up. You've done some demo tapes, anything along those lines for yourself. Maybe you've put together a portfolio. Well, any costs related to that, make sure you're taking deductions for. So while it may not be necessarily for a specific contract that you're going into, but it was so you could go out there and get that contract, right? You needed something to go and portray to show yourself off in order to get that business, to get that ability to even sit in front of somebody and have that conversation. Any other professional services that you are incurring throughout the way? I have a miscellaneous category in here because not one size fits all, and really things do come up, things that are very much relevant to the income that you're generating and to the expenses that you have. So you might have even things like your paints, your paintbrushes, canvases that you're putting together, could be backdrops that you're purchasing. All of these different things will fall into this miscellaneous category. Any other specific materials and supplies that you're getting into. And then here's another category that I find a lot of people do forget about a lot of times. And this is called, this is your bank and credit card interest and service charges. So I always recommend to people to make sure that they have a separate bank account for any of their business activity. You want to keep your personal stuff separate from your business stuff. And there's multiple reasons for this. The first and foremost one is it just makes it so much easier for you to track what's gone on into your business. So for your business related stuff that you're going to have to report later. So all your income coming in and then all of the expenses going out being related to the business. I also recommend not just from the bank account side, but a credit card. Have a separate one for that reason too. I don't even care if it doesn't, like it's better to be in the business name, but if it's not in the business name, it doesn't matter. Just have it separate that you're only using for that business activity. So from the tracking side is the one reason. And the other big one is you don't really want CRA looking at your personal business. You really don't want them looking at anything they don't need to, because then they're going to question any and everything that ever comes through there. Let's say even just your mom happened to send you a birthday present and he transferred you $100 for no reason. Well, the government at that point is going to go, well, what about this amount that went in? And what about that amount? And what about that amount? Well, you should be taxed on all of this money that's coming in. I think that's all income. Well, if you have it separated, then nobody's going to be going into that side of things. They're just going to be looking into your business account and looking at your business activity. Trust me, it's better to have less going through there that is not related to the business. You don't want any of that going in there. Keep it separate. Keep it separate for your own sanity. Rentals and repairs. So maybe you've had to rent something, again, in order to perform business. Any repairs you've had to do to any of the equipment maybe you've purchased previously that you might have to do, or any patchwork on anything. And then there's also entertainment in here. And I have this separated from even the advertising and promo, because sometimes it's important that you're out there at entertainment related items to go out there and network. So again, being reasonable. So you're not going out and buying season tickets to something and then trying to play off that it's all business related, but maybe there's a specific event that you went to because you knew certain people were going to be there and you wanted to rub elbows with them. Or somebody told you they were going to be somewhere and you felt it was important that you showed up, and you incurred an expense related to that. So again, these are the types of things that you want to do. But if they're entertainment considered related items, they're only 50% deductible, similar to like how your meals are, okay? And this does not include golf. Golf is not deductible. Green fees are not deductible, but if you eat on the premises, then 50% is deductible. So that's really like summing up the whole side of the actual deductions coming through. So that part is important. Now let's talk about the filing, the specific filing requirements. So when is it actually due? So April 30th for employees. Self-employed individuals is June 15th. But for both of them, you want to make sure that you are making all of your payments that you need to make by April 30th. Okay, so estimating again, as I mentioned before, even if you don't have your filing ready in time by April 30th, still make an estimated payment towards what you think your tax bill is going to be. So just take it as far as you can. It can take you longer because you have more to do, but you can still be compiling stuff after that date, but you should always kind of know where you're kind of sitting at by then. Yes, it may not be optimal from a timing perspective to always do that, but it is better to do that in the long run. Otherwise, they can charge you interest and penalties related to that. So let me touch on, I'm going to get into tax-free. I'm just looking at the time here because I know we're breaking. I believe it's at, is it at 3 or 3:15? I think it's at 3:15.
3:30, but we could do whenever you feel like.
Okay, no, that's good. 3:30 is fine. 3:30.
Gotcha.
Okay, so just so I know from a timing on a topic perspective. Okay, so TFSAs, let's talk about tax-free savings accounts. We're going to talk about RSPs as well because these work very, very differently, and it's very important to understand the differences and how they affect you from a tax perspective. So with tax-free savings accounts, what you'll see here is there's annual dollar limits that I have here. So the program had rolled out in 2009. So from 2009 to 2012, there was an annual TFSA dollar limit that came out of $5,000. So what do I mean by that? So that means the government said every individual out there gets to save $5,000 a year, and the government can't touch any of the money you make in that account. So if that money grew to $10,000, for example, we're not going to tax you on the $5,000 income. Now, if you had put that $5,000 in another mechanism and it grew to $10,000 without you contributing anything else, they'll tax you on that additional $5,000 of income you made. So that's where this is a really great savings tool. And I believe that the government came out with this because they were realizing people weren't saving enough money for later on down the road, for the rainy day, for retirement and all that stuff. And they wanted to really encourage people to start saving money. So $5,000 is what they had from 2009 to 2012. 2013 and 2014, they raised that amount to $5,500. In 2015, they were very nice to us and gave us $10,000 we could do. 2016 to 2018, they dropped it back down to the $5,500. And in 2019 to 2022, so that was up to the end of last year, it was $6,000. And then this year they've adjusted it again due to inflation up to $6,500. So here's a really great link that if you wanted to know more specific information on the program that you can go to, and it will give you really all the ins and outs when it comes to this, what the different mechanisms are, what you can do in a TFSA account, because there's a lot of things. When it first came out, a lot of people thought it was just you could put cash into an account. Well, that's not just what this TFSAs are anymore. You can do a lot of investing within the TFSA accounts now, and there's all kinds of options. So very good to go and have a discussion with your financial institution, any financial advisors that you're working with, and they can guide you in the right direction when it comes to that. Now, the other thing with this too, that's really important is that your room increases each year. So if we go back to this chart for a second, you'll see in here that in each one of these years, there was different values. So let's say between 2009 and 2023, I had never contributed, but I was eligible to be able to contribute into a TFSA account. Well, I can add up all of these numbers for each one of these years and now do my contribution. Now, if you have a CRA My Account, that's the best place to go and look and see exactly what your room is. And if you don't have a CRA My Account, I suggest each and every one of you do that, so you always know where you stand with the government and know what's happening. Most people ended up with one just from going and applying for various COVID benefits that have come out. I believe that was the only way they were allowing you to apply. But it's really important to know what your different limits are. And that's both from this TFSA side and also the RSP side that we'll talk about shortly. So if you haven't been contributing into them, what's really great is that all this room is still sitting there waiting for you. So when you do have an amount of money that you can go and invest somewhere or to go and save, you can go put it away. And what's great about the TFSAs is that it is accessible. While you can't go and necessarily take it out of that vehicle right this second because you need it right this second, it's usually available to you within a couple days. So it is reachable, but not too reachable, so you don't go spending it all the time, because the whole idea is to save it. So I'll reiterate, as I mentioned before, growth is not taxable in here. And what it doesn't do is affect your future room. So as I had mentioned in the example before, that if you went to make a contribution of $5,000 and that grew to $10,000, you don't pay tax on that $5,000, but you also don't lose your room, your future room. So it wouldn't mean that the following year, if you were given $5,000 of room, that you don't have that anymore because your TFSA account has grown. So when you're looking at your contribution room, don't look at how much it's grown, look at how much you personally put into those accounts. And that's the only thing that's going to reduce your room, what you put into the account. Now, what happens if you've got to access that money? So if you've got to withdraw that money, your room will come back. So let's say I put in $30,000 cumulatively up to this point to my TFSAs. You want to make sure that if you're withdrawing that $5,000, you wanted to maybe put it back in, and you only plan to take it out temporarily because I just needed to get by in between contracts. Well, when your next contract comes in and you get more income coming in, you can put it back, but not in the same year if you've already used up all your room for that year. That room, contribution room, will regenerate for you the following year. So if I took it out in 2022, for example, I don't get that room back until 2023 hit, but you can put it back in. Now, one of the other things that can happen a lot with people in your industry is that you may find yourself maybe across the border at some point in time. So when you become a non-resident, you're allowed to keep your TFSA in Canada. So you can keep it in that savings vehicle if you'd like. Canada's not going to take that away from you, but you can no longer generate room for those years. So really important to understand, because sometimes on the CRA My account, when it's showing you your contribution room, it's not taking a lot of that into account because they don't know what your residency status has changed at that point a lot of times, or maybe they haven't updated it in their system yet. So don't always go by that if you know your residency has changed, because you will not get that future generation room. Your regular room is there, but no future room is going to be generated. And TFSAs and any income that you're making on those TFSAs is not going to affect any of your other benefits that you're receiving. Now, I keep referring to a certain amount of room that you have for your TFSAs because you are limited to the amount of room that you do have. So there is a penalty if you do over contribute. It's 1% per month penalty. So if you are over contributed by $2,000, for example, then you'd be paying a penalty of $20 per month as long as the amount is still outstanding. So my recommendation to you is to always make sure that you're on top of that. And the minute you realize that you've over contributed, if you find yourself in that unfortunate position, is to take it out right away, because you want to stop that penalty from happening. So just get it out, the penalty will stop accumulating. But they will charge it to you for as long as it's in there. Now let's talk about RSPs. So RSPs, here's another great link on here, similar to like the TFSA one I gave you if you wanted to see more detailed information. Really, really great resource on here. The difference with this one now is that your room is generated off of employment income. So remember, with the TFSAs, everybody's getting the same amount. Doesn't matter how much income you make or anything. Everybody gets the same amount they're allowed to contribute each year. Now with RSPs, generated off of your employment income. So that includes self-employment income. But keep in mind, that is not your revenue number. That is your net income number. So that's after your expenses. So if, for example, you've been reporting next to no income over a few years, well, you haven't generated any RSP room because you haven't been claiming a lot of income. So it's very important to understand that correlation, that you don't create that room to be able to contribute to RSPs unless you're reporting income. Now, the reason for the correlation on there makes complete sense. And the reason is because while TFSAs are not taxable on their growth, RSPs are not taxable until you take them out of these vehicles. But when you put the money into them, you get a tax deduction for that. Now with TFSAs, when you put money in them, you get no tax effect on that at all. What you're getting is the future benefit of it. RSPs is when you put it in, you get the tax benefit. When you take it out, they want their piece of it. So they're going to give you some benefit, but they're going to take it away later when you have to take the money out. So just keep that correlation in mind. Now, how is it the room generated off of employment income? It's 18% of your earned income is what makes that contribution limit increase for any future year. Okay, so 18%, and there is a maximum amount each year. And remember, it's on employment income only. So even if you received investment income from other areas, that's not where you're taking your 18% from. It's only on the employment related income. Now it's reduced by any contributions made by you or an employer into an RSP and RPP. You'll want to be careful with any unions or anything like that that you might be affiliated with, because some of them are making RSP contributions directly for you. So it's really important to know, or maybe you have an automated thing set up with your financial advisor and they're just automatically doing contributions for you on a monthly basis. You want to make sure you're factoring that into any of that RSP room you have available for doing the contributions, because you don't want to end up in an over contribution scenario. Now, another thing that's needing some clarity on here too, so I did mention that there's a tax benefit when it comes to RSPs and when you're doing any contributions here. So the one thing that's really important to understand is that it's not going to take away your tax dollars. So let's say, for example, you're looking at, okay, I'm in a position now where I am going to have to pay taxes payable of $5,000. Okay, I'm going to solve this problem. I'm going to go and make a $5,000 RSP contribution, and then I'm not going to have to pay tax. Well, that's not true, because for that $5,000 taxes payable amount, that would have been a higher taxable income amount. And the way it works is your contributions offset your taxable income, not your taxes payable. Okay, so let's say to generate that $5,000 taxes payable, there was actually $10,000 of income related to that. So maybe you had to do a contribution of $10,000 to make that $5,000 taxes payable go away. Still, it doesn't mean that it's not a good thing to do, because it might be for your situation. But it's just important that you understand that it's not going to take it all away if you're only doing the taxes payable amount. Okay. The other thing that you want to look at too is that what's beautiful about the RSP contribution timeline is that that doesn't work the January to December like TFSAs do. It's actually the last day of February. This year was March 1st, where you have the ability to see all of your numbers and where they land at the end of the year before you make your decision on whether or not you're going to be making more RSP contributions to help your tax situation. So it's very good to go and try and get everything all together as soon as possible so you can see what those numbers are and really see if you want to give yourself a tax benefit so you don't have to pay those taxes. So really important it really is to your benefit to be ahead of the game and take a look at where everything's kind of landing, because it could end up in a lot better of a tax situation. Now, I'm going to go back to this before I go to the HPP. The other thing I wanted to kind of get into here is keep in mind, as I mentioned, that you will have to pay taxes later when you're taking this money out. So one of the things that you really want to make sure you're considering is, what is your tax bracket? Is this really going to help me now in comparison to later? And we'll talk about that a little bit more when I get into the different comparisons on when TFSAs versus RSPs make one more sense than the other. But it's definitely something you want to factor in when you're deciding is, what is my tax bracket today? Because the brackets are different. As you get higher, you're paying more taxes. So RSPs can be a really good vehicle to help bring that tax burden down in those years where your tax bracket is higher. Now let's talk about the home buyer's plan. And the reason why I want to talk about this now is because it's very directly correlated with RSPs. So the home buyer's plan, there's a link up here as well to give you a little bit more details on the plan and how it really works, the ins and outs. This was a great plan that came out not too long ago. A lot of people are aware of that, which is great now. And what it does is it allows you to withdraw up to $35,000 from your RSPs. As long as you pay it back over 15 years, there's going to be no tax effect to you. And they'll give you a schedule with respect to what your expected amounts are each year. And if you don't make that contribution back to your RSP in each one of those years, then you will be taxed on that amount in that year. The great thing about this is that they're not going to withhold any tax. Normally, when you do withdraw from your RSPs, there is a small amount of tax that they are withholding, usually about 15%. Never enough, just so you know, never enough for your tax bill at the end of the year. So always be expecting to pay a little bit more taxes in any one of those given years. But in this situation, when it's the home buyer's plan, you won't be in that situation. You're not going to be taxed on it because you are going to have that ability to repay it over the 15 years. And as long as you meet that guideline, you won't pay the tax. Now, there are some certain conditions related to this. You need to be a first-time home buyer. You must have a written agreement to buy or build that home. You must be a resident of Canada when you withdraw or buy. So keep that in mind, that if you know you're going to be doing some work across the border, try and time it. So you're a resident of Canada at the time that you're buying. Intend to occupy the home as your principal place of residence within 1 year after buying it, okay? Or building it, because building it does count now too. Now, this is another plan that's directly related to your RSPs as well. And this one is one I find that a lot of people don't know about. You have the ability to pull down off of your RSPs and repay it over 10 years because you've decided to go and learn how to do something else to generate income for yourself, and you're changing your profession. Very clear guidelines on this is on this link, so I suggest you take a look at that. The question is how much? It's not as much as the home buyer's plan, but it can still be very beneficial. So up to $20,000 from your RSPs, $10,000 in a given year, and then like the following year, you could take another $10,000 or even the year after, but in total only $20,000. And what's even greater than that is the fact that you could potentially do this for even $40,000 because your spouse can as well, right? So your spouse can also purchase it for you, which is great. So they can pull down the $20,000 too, and in order to give it to you, in order to do this lifelong learning plan, which is amazing. A really important point though is this is very different from RESPs. RESPs are for your children. The lifelong learning plan is not for your children. So you can't use this for your kids' education, only for yours or your spouse's or your common law partner. Another great thing on here is that you might think, okay, well, my tuition is only $5,000, so I can only take $5,000 from my RSPs for the lifelong learning plan. Well, the answer to that is no. You actually are not limited to the amount of your tuition or any of your costs related to that. The reason for that is because they recognize the fact that you're stepping away from other income generation that you're getting. So they recognize that you're not going to have other income to sustain your life, to pay your rent, to eat, to live. So luckily they allow you to pull that additional amount as well, even if it's above and beyond the tuition value, which is great. And then you have until January of the 4th calendar year after you've made your first withdrawal out of the plan to make any additional withdrawals. So as I mentioned, it's $10,000 in a calendar year and up to $20,000 in total. So for example, maybe you took $10,000 out in year 1, but you found in year 2 you didn't need it. Well, you can still go and take it out in year 3, for example, if the program's still going on. And as long as you still qualify within that 10-year repayment plan and it hasn't begun, okay? So that's really how you can utilize the different RSPs that are happening. Now let's do a recap on the TFSAs and the RSPs as a whole. So RSPs, if you do over contribute, there is a little bit of a threshold. We didn't talk about that, of $2,000 that if you over contribute, they won't penalize you on. I usually tell people don't bank on this $2,000 amount because mistakes happen a lot with RSPs, especially when you have somebody else who's managing maybe some of the contributions for you. So it's very easy for the calculations to kind of get messed up, or your timing for what you think counts in one calendar year versus another can kind of get messed up. So never rely on that $2,000 allowance. RSPs don't have any extra allowance on this for you. So really important not to over contribute so you're not getting that penalty as we've gone through before. And in the example, the $2,000, $20 per month is what it could work out to for that. So RSPs give you the immediate tax benefit. So in the year you make that contribution, or in the January, February of the following year, when you make that contribution, you're going to get that immediate tax benefit. So it's really going to help your overall tax situation. Now, when you take the money out, though, as I mentioned later, that's when you're going to be taxed on it. TFSAs are very different when it comes to that. So it gives you future tax benefits. So when you put the money into the TFSA vehicle, it's not going to affect your tax situation at all today. But any growth that happens in those TFSA accounts, they're not going to tax you on for any of that investment income. Whereas if it was in another vehicle outside of the TFSA, you would be taxed on that. So how do you decide between them? Well, I've got a link here to a blog that we have. You can also connect to it through our website. And it's all really about when should I contribute to an RSP versus a TFSA account. And really what it goes into is the details behind, okay, from a timing perspective, you've really got to do some planning here. What does your life look like? So today, what is your income level from all your income sources? So if you were to tell me right now that your income was not going to be more than $45,000 in the year overall, then I would tell you, you know what, this isn't really a good year to do an RSP contribution. And the reason I'm going to tell you that is your tax bracket is the lowest tax bracket you could have. So there's going to bring you no tax benefit as far as a cumulative time frame. So while it may help your current tax situation this year, when you think about when you're going to take that money out at a later date, is it possible you're going to have more than that for taxes that you're going to be paying? And then think about the growth that would have happened in that RSP account of all that extra income. Now you're going to put yourself potentially in a higher tax bracket, and it's going to end up being worse for you. So you don't want to give them more, you don't want to give the government more money than you need to. So I try to look at it a holistic view, okay? And RSPs are not always the right answer for everyone in any given year. Now, having said that, let's say last year you made 45,000, next year you know you're going to make 45,000, but this year I had an amazing year and I made $100,000. Okay, now you're on a higher tax bracket than you would have been when you were in the 45,000. So this might be a good year to make an RSP contribution if you're a believer in RSPs and you have that extra money lying around, because now you're playing with your tax brackets. So when you're trying to decide if you have any extra money around, whether you should contribute to a TFSA or an RSP, you got to look at what your tax bracket is in that year. Is this a high income generating year? If so, RSP might be the right answer for me this year. If this is a low generating income year for me, then TFSAs might be the better way to go. Okay, and this is all described in that blog there. If you wanted to take a look at the article and you just want to remember all the different aspects of when to think of it versus the other, you can definitely review that. But it really does come down to it being that simple, which is TFSAs, low income years, high income years, RSP contributions. Now, the next section I've got here is to do with some of the new credits that the government has come out with. So this is a really great one they came out with, and I was really excited about it when I saw it. It's the Ontario Staycation Credit. So did any of you travel within Ontario and are an Ontario resident in 2022? If so, I really hope you kept those hotel and accommodation bills, because if you did and you paid HST on any of them, you could get a nice credit for this. So what they had said is, if you had taken a vacation in Ontario for less than a month, refundable credit. So it's a refundable credit because sometimes they come out with a credit and you can only use it towards offsetting any other taxes that you've got to pay. Well, this one's a refundable one, so they'll actually give you a refund in this situation, which is amazing. So the receipt must show the expense was subject to GST, HST in order to be eligible. So you'll want to look to see that they charged you HST and there's an HST number on the receipt. That's really important. And your name must be specifically on the receipt. So you can't use it and claim it for your taxes if somebody else had signed up for it. Even if you paid for it, if their name's on the receipt, they're the one who can take the deduction for it. And you must have been a resident of Ontario on December 31st, 2022. So even if you were in another province at the beginning of the year, as long as on December 31st, 2022 you were, then you can do that. And there's one credit per family. So if you are married or you have a common law spouse or anything, both of you cannot try to get this credit. Only one of you can claim for it, but you can apply under the family credit. And it's 20% of the expenses, up to $1,000 for one person, an individual, or $2,000 for the entire family unit. So it really adds up. This one's worth it. It's worth going hunting for those receipts because that's a lot of money going in your pocket that you can definitely put to some good use. So I just wanted to make sure you guys were aware of that. And I do have a link on the top of this slide as well that will bring you to the government website that talks about this in more detail as well. Now, this one isn't good news at all, really. This is something that the government did come out with. It's called the UHT, the Underused Housing Tax. There is a link here. There's a lot of uncertainty around what exactly this means, a lot of gray areas. There's a lot of different tax seminars that are going on right now with the government. Accountants like myself have asked them a lot of questions because there is a lot of these gray areas on whether or not certain people it applies to or not. So I do suggest you go through this link on here, which really goes into details on the different scenarios and figure out whether or not this applies to you. But the whole idea of it when it came out is a system of reporting that's separate from your tax return. So this does not get filed with your tax return, but it's due at the same time. So it's really important to understand from a timing perspective. So it mainly, so not only, but mainly affects individuals who are not Canadian citizens or permanent residents who have vacant or underused property. And it's separate from any of those surveys that you might have done as a homeowner that you were required to fill out to do with any occupancy or vacancy. This is completely separate from that. And the whole idea around this was they could charge you tax on an annual basis of 1% of the ownership of the vacant or underused housing in Canada that took effect on January 1st, 2022. Now, let's say you are not necessarily having to pay this tax on here. It does not necessarily mean you do not have to file this form anyway, okay? Because even though you're exempt from the tax, you're not exempt from the filing itself. And you still have to file the form and just not pay any tax in some of these scenarios. So I do suggest anybody who does own a residential home that you are looking this up to make sure that this doesn't apply to you. If this is the home that you're not living in completely, take a look at the rules on this, even more so if you had opened a corporation and your corporation owns it, because now this part of being a Canadian citizen or permanent resident doesn't matter anymore. If you held it in a corporation, even a Canadian corporation, you're required to file. So really important to go and take a look at this and fill out the form. The form itself is not hard. It's figuring out whether or not you have to actually file it. So it's just important to file it if you feel like that there's any chance you possibly may need to in order to avoid any penalties. And the penalties are very stiff. It's $5,000 per individual. And if it's a corporation that owns it, the penalty is $10,000 for not filing. So you do want to make sure that you are filing this form. Another measure that came out this year, this is one that is another good piece of information. So I go back and forth. I hide the bad news in between two pieces of good news. So the first home savings account. This is really great. So this is in addition to that home buyers plan that was related to RSP. Well, the FHSA, which is the first home savings account, is a mechanism very similar to like how the TFSAs work. And the idea is you're going to save money in here into this account in order to buy a home later, and the government's not going to tax you on the income that's coming into here. So another really great saving mechanism if you know you're going to be buying a home. I do have a link on here. This is getting launched next month in April. And I do recommend if you find yourself in this situation where you could utilize an account like this, go talk to your financial advisors and figure out how it's specifically working with them. Anti-flipping measures. This is something else that did come out. I mean, the government has really always been all over this kind of thing, but they've never really gone after people for this. But it's really important that you do look into it. And it's for property that's sold and is owned less than 365 days. They're going to be taxing it as business income. So where they might have been looking for this before, it was more from the side of, okay, am I going to charge you capital gains because you didn't really live in it? You may have lived in it, but then you lived in another house and really you were just living in there for a couple of months and we'll charge you capital gains. Capital gains tax is very different from business income because capital gains, you're only getting taxed on 50% of the value, whereas with business income, you're getting taxed on 100% of the value. So this is where there's a bit of problems on here because now you're getting double taxed if they're going to look at it and treat it like it's business income. So you want to make sure that you're in the property for 365 days before you turn around and try and sell it. There's always going to be exceptions due to changes in life circumstances like death, divorce, changes in members of the household, all of that type of thing. Obviously, there are going to always be some gray areas and some exceptions around there, but they are really going after people after 2022 in relation to this. So it's really important that when you're planning to try and keep moving, and maybe that's something that you just love to do, which is to move into a place and fix it up and then go and sell it. Well, just make sure you hold on to it for 365 days so they're not taxing you at the business income level. So this is when we get into the next topic of HST, and I think this is actually a really good breaking point for a break because the HST is a big topic.
Yes, for sure. How long do you think we should have this break for? 5-10 minutes, maybe?
Yeah, why don't you give everybody 10 minutes and then we can come back?
Great. Okay. So everyone, thank you very much for staying with us so far. So we're going to start again at, I guess it's almost 3:28 or 3:30. So let's do 3:30 actually.
Okay, great. We'll see you back at 3:30, everyone.
Hello.
Hello.
And I guess we're back. Just a quick reminder. We've been asking participants to leave any questions you might have in the chat so we can ask Kelly about it when it's time for the Q&A session. So thank you for staying with us. Back to you, Kelly.
Okay, thanks. Okay, so let's get into HST, a topic that I know kind of drives everybody nuts. So the way you need to look at this is a separate reporting from your income tax. So if you have registered for HST, this is something that you're going to need to report on separate from your income tax filing, and you'll be reporting on your expenses and your income a little bit differently if you are in an HST situation. So let's talk about the different kind of groupings we'll talk about on here. So I have a separate little agenda for HST. So registration, how that all works, reporting, when you need to report on this, and any installment payments you might potentially have to make, penalties and interest if you don't make those installments or you don't pay on time or file on time, and also deregistration, which is a piece that a lot of people forget about regularly. So similar to other topics, I do have a link on here, which really will give you a lot more detailed information. If there's anything I'm not covering on here or you have questions at a later date, please do feel free to use that link and go through it. Brings you right to the government website that goes into all kinds of stuff. You'll see when you go in there, it's quite in depth, and it does go into various topics depending on what it is you're looking for. So first, let's talk about registration. So you can register for an HST account online. We can also call CRA at 1-800-959-5525. This is a really important number for you to have because anytime you have any questions around your HST, this is the number that you're going to call, and they can guide you. The one thing I'm going to warn you of well in advance is grab a coffee or tea, grab yourself something else to do because you'll probably be on hold for a while. So keep yourself occupied and busy and put that phone on speakerphone while you're on hold for a little while. If you luck out, it won't be too long, but it can get quite long, especially in tax season, to get through to somebody. So now when it comes to reporting, generally, if you're incorporated, for example, it's 3 months after the year end of your reporting period. If you're incorporated, for example, that's going to be depend on what your year end is. So if you're a December year end, 3 months after is going to get you to March 31st. Hopefully there's nobody here that has not, who's in that situation and hasn't already come up with their numbers because that's going to be due in a matter of days. If you are self-employed, then that's going to be due on June 15th, similar to your income tax return. Same idea, same filing deadline. And that really is meant to align with the income tax filing because it's the same numbers you're looking at and the same type of reporting that you're going to have to do in segregation of HST amounts versus your regular income amounts. Now, you might find yourself in a position where you have to make installment payments. And this isn't even just for HST. This is really for any time that you have to pay any tax to the government over $3,000 for any type of income tax as well. So even from your personal tax standpoint, if you're in a taxes payable situation of over $3,000, they're going to want you to install for the year ahead. This, I'm not going to lie, it really sucks if this happens to you in your first year because you're going to have not only that tax bill for that current year, but now you're going to have to also start coming up with the money towards your tax bill for next year. So it's almost like a double hit in that first year, but it all works out to the same thing in the end, because by the time you get to the next year's tax filing, that tax bill should be really much already paid if you're in the same situation. So when are those installment payments due? Generally, these are the timelines they give you for them. So from January to March, your installment payment would be due April 30th. April 1st to June 30th, it's due July 31st. July 1st to September 30th period is October 31st. October 1st to December 31st is due January 31st. And in most situations, the CRA will send you a notice with respect to what they're expecting your payments to be. They don't always, so don't always rely upon that. Just know as a general rule of thumb, if you've owed over $3,000, you should be making installment payments towards that for the following year to make sure that you're doing that. Now, a question that I get a lot is, well, what if that was an unusual year and I'm never going to make that again? I'm never going to have a taxes payable over that. Do I still have to make those installment payments? Well, in the eyes of CRA, the answer is yes, you do still have to make those installment payments, and they would refund you when you file the return. But the other side of me says, you know what, if you know with absolute certainty that you're not going to reach that number, and what I mean by reach that number is I don't mean the 3,000 threshold, I mean that taxes payable number, then just remit the amounts that you know that you're going to have to pay. Because the problem is if you don't pay enough, then they're going to charge you penalties and interest for under installing. And you don't want to end up in that situation. So you want to make sure you've been installing as much as you can. I usually recommend that you make those first couple of payments at first and then just keep reevaluating. So do your books ahead of time, try and stay on top of your books in those situations so you can kind of see where you're falling and where your numbers are landing for the year, so you know what kind of a situation you're going to be in. And then if you find when it comes around to the third payment, well, if the third payment you say you're kind of on the border, I don't know, well, make that payment too. And then if you're going to go to the fourth period, then you say, you know what, I absolutely am not making this number. I can see my numbers up to the end of December. There's no way I'm hitting this number, and you don't want to make that last installment. Then that's a decision you can make. Just know if you're wrong, they can charge you the installment interest and penalty on that amount. Now, when it comes to HST as a whole, the question is, well, do I even need to register for it? Well, the answer to that question is, it depends. What is your income level? So once you have reached $30,000 in a 1-year time span, and when I say a 1-year time span, I don't mean January to December. I mean 4 rolling quarters is what they refer it to be. So that could be from March 1st to February 28th. It could be from June 1st to May 31st. You have to really follow what that 1-year period is. And once you reach that 30,000 threshold, that's the minute that you need to make sure that you are registering for an HST account and starting to charge HST moving forward. Just don't forget that once you do register for that HST account, you are required to collect HST for every piece of income that you are now starting to incur. That is not T4. Okay, that is not from an employee relationship. It's from your contract self-employment business side of things. At that point, you must register for HST. So what happens if you don't? Well, if you don't, CRA is going to come back to you and say, hey, you should have been collecting this money. Because as far as CRA is concerned, when it comes to HST, is that you're doing their job for them. So you are collecting HST on their behalf, and you're only the intermediary, collecting it from them, from the clients, and then remitting it to the government. It's never your money. It's never your decision to make. It's the government who's regulating this piece for you. So if ever you find yourself in a tax situation where, you know what, I'm low on funds right now, and I don't know, I just can't make all of these, I can't pay all of these payments right now all at once, and you have to choose between paying an HST bill or an income tax bill, pay the HST bill, because they have zero tolerance over that. That is the area that they will audit first. That is the area that they will come after you first. That is the area where they'll take legal action. They'll freeze bank accounts because they have no tolerance for HST not being remitted, because they say it was never your money to spend. So that's always the one that you want to make sure that you're on top of and you're doing properly. So what happens in the situation where you have collected you did not collect the HST, but you had an HST number? Well, in this situation, you have 2 options. So first and foremost, the government's going to say, regardless, that you've got to give them the money for that HST that you should have collected. So now your 2 options are only in the how do you get that money? Who's paying that money? It's you can go back to your clients that you should have collected it from and hope they're going to pay you that, because you can give them a new invoice that has the HST value on it. Now, if they don't pay that, then you're stuck with the second option, which is you're going to have to pay it. And at this point, what you would do is you would lower the amount of income, right? So you take the HST out of the income value, and then you would remit the HST portion of that amount and remit it to the government. Now, that's if you caught it ahead of time before you did your reporting. If this happened afterwards, then you can't build it into the price anymore. And now you're going to have no choice but to come up with that additional money to then just give it to them on top of that, unfortunately. So if, let's say, that invoice was for $1,000, then you're going to have to come up with $130 to remit to the government with respect to that. So HST is one of those things that's really, really important you stay on top of, and you make sure you're remitting properly. So that's as long as the HST number is active. So from the day it's active until the day you close it. So this is where you want to make sure that you're deactivating the account when you're no longer using it. If you don't think you're ever going to hit that $30,000 number again and you're winding down the business, you can close the account. Just make sure you don't go above the $30,000 in that period after you've closed it. And make sure that you actually do the closure and you have an effective date of the closure. So you stop collecting the HST at that point, and making sure that you are remitting HST returns up until the point that that HST number is closed. So let's talk about what would happen in the situation if you had remitted too much or too little. So generally it's 5% of the amount plus 1% per month of the difference between what was reported and what should have been reported, and the same scenario for what was paid and what should have been paid. So a lot of times, if you're not sure, and anytime you think you're going to be late, even with a filing, whether it be an HST, income tax, or anything at all, always throw some money on the problem, okay? That's really the solution when it comes to penalties and interest, because what they're charging you on majority of the time is all based on the money they have in their hands, because they want to make sure they're getting the money. Now, if you've already paid the bill, this is not where you're going to get that, but that's going to reduce that bill, because it's all based on what is the amount that you owe them at that point in time is what they then go and generalize the interest that needs to be up there that they're going to charge you. And it is up to a maximum of 10%. So deregistration is the next category on here. So as I mentioned, remember to deregister when you cease to conduct business or charging HST anymore. You're going to call that same phone number, 1-800-959-5525. That was on this first slide, to deregister as well. And then you can close off the account. Now, before I close off on the HST side, I want to go through how you report on this. So as I mentioned, this is a separate HST filing, and you can file it out online. If you have a My Business account, if you don't have a My Business account, I suggest you register for one. That's the easiest way to file HST returns. So you would register for a CRA My Business account, and on there you would select Net File HST e-file, and you go through the steps on there to report. So the type of information they want you to report on this is your income. So this is your total income that you've collected on your invoices. This is the value without the HST. And then they're going to ask you, well, how much did you collect? So then you're going to put in the amount related to the HST that you collected on those invoices, and it should match. So if you only did any business in Ontario, for example, then the HST rate is 13%. So it really should be 13% of that income. So for example, if you had $100,000 of income that you're reporting, well, then the next line item for the amount collected should be $13,000. And if it's not, you're probably going to get a phone call from CRA questioning it. Now, what if you say, well, I had some other areas where, you know what, HST wasn't applicable because this was business conducted outside of Ontario, outside of Canada, and HST wasn't applicable for these services. So in those situations, or they might have been exempt services, for example, and there is a full list on what are exempt services from HST. Again, you can go back to that link that I provided to take a look if that falls in any of the categories you have. For any of those different items, there's a separate box on there that you want to select. So there's income that is HSTable, and there's income outside of it. So you want to make sure you're segregating it by those two boxes so they don't make that phone call to you and question the amount of HST you're showing is collected. Now there's another section on here, and you want to make sure you're filling out this one. So go back and think about all those expenses we just talked about earlier on in this session, where I mentioned all of these different business deductions to you. So there's something what's called ITCs, and that's called input tax credits. And what that is you have the ability now to claim as a deduction against that HST you collected, all the HST you paid in those various expenses. So you want to be careful, because you can't just automatically assume it was 13% on all of those expenses, because some of them you might not have been charged HST on. So unfortunately, this is where the bookkeeping side of things come, that you're going to have to go through the receipts and figure out which ones had HST and which ones didn't. But it's definitely a worthwhile exercise to do, because it's going to reduce that amount. So while I did say that the government says you're collecting that all on their behalf and then sending it to them, they're also saying we recognize that you have HST you've paid, so you can keep that part of the money to repay yourself. But you've got to do the reporting properly on here. So you're going to list all of the HST that you paid in that same period that you're filing for. And usually you're filing for the 1 year period from January to December. And you're going to put in a box in there for the amount of HST that you've paid out. And then you're going to come to a net number. So let's say you had the $100,000 of income. We'll use round numbers here. $100,000 of income. And you had $13,000 that you collected in HST, but let's say you had $100,000 in expenses too, and you paid HST on all of it, and it was $13,000 of HST. Well, if I take that collected amount of $13,000 and the HST that I paid out amount of $13,000 and subtract it from that, well, now it's zero. So now I don't have to give the government anything. Wouldn't that be great? Now you might find yourself in an opposite situation where it's not like that, and maybe instead of the expenses being $100,000, then they were maybe only $50,000. Let's say not everything was HSTable, so only about out of that 50,000, there was probably only about 5,000 in HST you paid. So now you're going to take that 13,000 that you collected minus the 5,000 that you paid out in HST, and you're going to have an $8,000 you need to remit to the government, which is still not bad when you look at it overall, because you got to keep 5,000 of it, right? So not too bad. So while I always do suggest to people, every bit of HST that you're collecting all the time, you should probably even have a separate bank account for, just to put it aside and not spend. Well, at that point, that would be quite nice, because now you have an extra $5,000 you weren't banking on that now you can put back into your regular main bank account and start spending. So you want to keep that in mind when you're doing the reporting for the HST side of things. Now, sometimes it might be one of those years where, you know what, you're investing a lot into things for the future revenue generation. And maybe this year wasn't the year where you had the high income. And it's possible your expenses might have been higher than your income. And that's okay. And you can report for HST purposes those extra expenses and get a refund. I will caution you though, one of the things that CRA was not all over in previous years was refunds, and they would issue the refunds to people. These years, I find they want to hold on to their money a lot more, and they start to question things a lot more when you are generating various refunds. But one of the beautiful things is that you have the ability to carry forward expenses and claim the HST you paid, what they call the ITCs, for multiple years ahead. So you can save some of those for next year or the year after, and feel free to claim those in another period, a subsequent period. Again, also keeping that rule in mind, it's a great way to make sure you're never late. So if you don't have time to do that full exercise of going through all of those expenses when your HST is due, and you have to remit that payment, just go through what you can, file what you can, pay what you need to, and then you can always use those additional expenses of HST later. So now you've done all of this and you've done your filing, you've submitted it, great. You make sure you make the payment too at the end if there's a payment to be made. Now, how does this affect your income tax reporting that you've been doing? Because now you've been paying HST and you've already claimed that HST portion on those expenses. So this now means when you're reporting on your income tax side, on your T2125, you have to make sure that you're not including the HST values on here, okay? Because you've already claimed a deduction for that. So when you're reporting your income without HST, and you're reporting all of your expenses without HST, because you've already taken that deduction for HST. Otherwise, you're double dipping is what they would say. So you want to make sure you're taking that out when you're reporting. And that's something I find that people forget to do when they've registered for an HST account. They just continue to report on their income tax side the same way they always have, which includes the HST value, and you just need to make sure you take that out. Now, there is other options too when it comes to HST. There's something that's called the quick method. And the quick method is a very fast way of reporting your HST where you don't have to go through all these different expenses. Now, I'll caution you on this because you want to make sure that you're in the right position where you're going to be on the better end of the stick of this one, because this is just a straight up calculation based on the income. So what they've done is come up with the various industries and the different percentages that you use to do the quick method of HST, where you take the income values and you multiply it by a rate. Majority of people fall into the 8.8% rate. So you would take your income times 8.8%, and then that's the amount of money you would remit to CRA when you're doing your HST filing. You don't take into account all of the HST you've paid on expenses and so on and so forth. You just go ahead and you file it that way. You pay the 8.8%. The people that this works the most advantage to are the people who have high income levels and very little expenses to offset that. If you don't find yourself in that situation, you do not want to use the quick method because you'll be paying them a lot more money. If your expenses are coming pretty close to or pretty high in comparison to your revenue, then that's where you definitely want to use the regular full method of reporting, because you'll end up in a better place at the end of the day. But like I said, definitely something to think about to make your life easier if you find yourself in the other situation. So now I have another section on here because I don't know if there's anybody on this session that's got a corporation and whatnot. Because if you have a corporation, you're doing some of your filings differently, right? Your income tax isn't going to be for your business is not going to be reported on your T2125. You're still going to have your personal tax filing to do as regular. Which you'll still want to file even if you don't have income coming out of your corporation to you. You still want to claim your medical expenses, your donations, all that regular stuff for yourself. But there's different options when it comes to paying yourself out of your business and how you're reporting that income to yourself personally. So the first question I ask everyone is are you a sole proprietor business or are you an incorporated business? And similar to that other topic, I do have a blog on this one as well on how to pay yourself through your business and the different considerations to think of at different points in time. So feel free to read through that at any point as well. So if you're a sole proprietor business, as I keep mentioning that schedule, because it's important that you're using it, the T2125, when you file your personal tax returns, you really do have limited options as far as income that you're reporting, because really it's all based on what are your earnings for the year, less your expenses. The number is what it is. There's really not much tax planning I can do for you other than saying, well, make sure you do all of these different deductions that we talked about today. Not too much I can do from the income splitting and all that kind of stuff. You can't do any of that when it comes to a sole proprietor business, because the amount that you earn in your business is the amount you report. The amount of cash that's sitting in the bank account at the end of the year doesn't matter. Corporations is where it's different. So if you've incorporated your business, you do have options. So what you take out of the corporate bank account is going to have an impact on both your corporate tax reporting and your personal tax reporting. On your personal side of things, you report based on what you've taken out personally, what you gave yourself as a payment. And then you have a choice on how you're going to report that money that you're giving to yourself. You can put yourself on payroll and issue yourself a T4 out of the corporation, or you can issue yourself what's called a T5 and give yourself dividends as the shareholder of that company. Now, let's say you have a spouse who helps you out with administrative clerical stuff or anything like that to do with your business, or maybe he's into this business on a daily basis with you. Well, it's important if you want to be able to be paying them exactly the same way as yourself, that they're a shareholder as well. As long as the contracts you have don't limit the fact that the corporation that's being paid has to be only by the one shareholder, because sometimes that's a consideration and you can't do that. So if you're both shareholders, you can have dividends. Only dividends can be distributed to shareholders, and that's it. Now, payroll can be paid to anybody who is going to be working for the company. Now, this doesn't include your 8-year-old child because you want to split some money with them. And just like they can't be a shareholder and be, an 8-year-old can be a shareholder, but it's in trust with another adult and whatnot. So the income's just going to get attributed back to you anyway in those various situations. So let's say you are incorporated and you're like, well, why would I pay myself payroll and why would I pay myself dividends? How do I decide? Well, there's definitely different reasons to do different things. Dividends almost always get you in the best tax position, both from the combined corporate and personal together, okay? Because let's face it, if you're the only shareholder, you are the business, you're the one still paying it one way or another. Because if there's no money in the corporate bank account, then the corporate bank account can't pay you, right? So you've got to look at it holistically. So, but there's different reasons why you might want to pay a little bit more tax or remit a bit more to the government and choose salary and employment. So it's important to understand the reasons you might want to do that. So it really comes down to 3 things. One, are you planning to go for any loans and mortgages? If so, salary and or employment income just looks way better and makes a difference on your qualifications and the rates that they're going to be offering you. So there's planning to do with that. And if you're working with an accountant, it's really important that you let them know that, because the decisions they make on what to do and how to distribute the income to you each year will change based on knowing what your situation is. The more you tell them, the better it is. Sometimes you may not think something's relevant, but it's relevant because that will change a plan or a strategy they're using for you from an overall tax perspective. And usually when you go for those loans and mortgages, they're looking at a 3-year average. So there's planning that needs to be done well in advance. So you can't just come and tell your accountant the year you're going to go, I just decided I'm going to buy a house. I'm going to buy a house next month. Well, now it's too late. So you have to start talking about the fact that there is potential for this to happen next year, potential for this to happen in 5 years, potential for this to happen in 3 years. Really, really important to just be as open and honest as you can so they can keep those notes in their file to make the best decisions for you. Another reason could be that you want to contribute to RSPs, or maybe you're aligned with a union or another employer on the side that's also generating RSPs for you and making remittances there for you and contributions on that side. Well, in order to do those contributions for RSPs, you have to have employment income. Dividend income, so if you're issued a T5 with dividends out of your corporation, that is not creating RSP room for you. That is considered investment income. So that's a reason you might want to do T4 income. Now, it doesn't mean you're stuck on one or the other. You can have a mix of both, again, for tax efficiency purposes to get your numbers okay. So as we're playing with the ideas of this amount could be salary, this amount could be dividends, it could be completely aligned to what your goals are and your overall goals are, okay? The other thing is too, if you have a corporation and you want to subscribe to a health benefit plan or a health spending account of some sort for you and your family, you can do that if you're considered an employee of the company. If you're just getting dividend income and you don't get any salary out of the company, then you're not going to be able to take a deduction for this because you're not considered an employee of the company. Now, having said that, again, you can do the mix of both. It just has to be at least a nominal amount of salary that you're attributing to yourself. So it could be something as low as $5,000 even, but it has to be reasonable. You have to have some sort of salary in there to be able to deduct that. And it has to be consistent. So you can't just do it this year and not next year if you want to have the benefit plan still active. Each year, you'll have to have at least a bit of salary coming through there. So let's say now you've decided, now what? I've decided I want to do payroll. So what do I do now? Well, there's a great payroll calculator that's on the CRA website that can help you figure out what you need to do here. So there's a link here to that site, which will help you do this. And what it does is it will generate those amounts similar to, it'll create like a bit of a mock pay stub, basically the same way you would if you were working for somebody else, where it gives you all the breakdown of this is the amount of your gross income, this is the amount for taxes being withheld, this is the amount of CPP, this is the amount of EI, and this is your net pay. So this is the amount that you should then take out. And you can work backwards, because let's say I want to take out $3,000 every month. Well, just keep playing with the numbers until you get that net pay amount to $3,000. So that's the amount that you can take out, and then you'll just keep raising the income value till you get there. And then you know how much to take out. And then it's also going to generate what's called the employer remittance form, because then the corporation itself has to then go and pay the CRA by the 15th of the following month, of any months you're taking payroll, a remittance to the government to remit that money, because the corporation does have to withhold that piece and send it in. And that's due by the 15th of the following month. And then you need to make sure you issue yourself a T4 slip at the end of the year. Now, let's say you decide to go the dividend route. Well, then you don't have to do all those calculations and worry about those remittances on the 15th of the following month, but you do have to also remember that you have to issue yourself a T5 slip at the end of the year based on the amount of dividends that you did take out. And both of these slips are due to be filed with the government by February 28th each year, okay, by the end of February. And that's really all I'm going to touch on from the corporate side, because that's a whole beast on its own. I could do a whole seminar just on corporations, but I just wanted to make sure that if you were finding yourself in that situation, you do know there's different options. The only other thing I will touch on with the corporations is that People ask me on a regular basis, when is the time to incorporate? And really it's when your income is steady and steadily high. Okay, you want to be outside of that regular tax bracket, because again, it's not going to bring you any tax benefit. If your net income is not going to be more than $45,000, there's no reason to do it from a tax perspective at all. When you're getting into those higher tax brackets is when there's a lot more tax planning that can be done, some tax deferral strategies, different things that we can talk about. But if you're not steadily over that $45,000 each year, it's not even worth a conversation, not worth the expense of incorporating, not worth the expense of having to file a tax return being done from a corporate side, because now you'll have a corporate tax return to file as well as the personal tax return. But happy to have discussions with anybody on that, on as far as any when the right time is versus not the right time. So that's about it from the corporate side I want to talk about, but let's talk about audits and what happens if you ever get CRA calling or sending a notice on an audit side. I know it's stressful. I know it's stressful, but honestly, it doesn't really need to be. It doesn't need to be if you've listened to and you're doing everything we've been talking about on this whole seminar. Because if you're doing things and tracking things properly, you're keeping your evidence of your receipts and you're doing all of those, you have everything to get yourself through it. The only thing is going to take you is time to prove it. So really there's 6 steps that you want to do in order to make sure you're being successful here. The first and foremost, you want to make sure you're contacting a professional, especially if they are the ones who did the filing for you. So if you worked with anybody who filed your tax returns for you and that's what's being audited, you want to give them a phone call right away, because they might have been reporting things in a different way than you might have specifically presented them, and they might have changed things around a little bit, and you want to make sure that what you're providing to them is going to be correct and verifiable against what was being filed. And they'll also know how to present it properly to the government for you. What the other thing you want to do is make sure that when you're responding, they usually send you a letter with what it is specifically they want, and they'll itemize it 1, 2, 3, 4, 5, 6, for example, and each one of those points will have a specific thing they're asking for. So usually they start out with, give me your top 10 highest invoices, give me your top 10 expenses. So even just using those, for example, on how you would provide them complete and easy to follow records. So the first one they've asked you for the top 10 invoices, you're going to give them your top 10 invoices. What were the top highest values of those top 10 invoices? So when you're providing them to them, you want to show them number 1, enclosed top 10 invoices. You're going to give them that. Then you're going to move to number 2, top 10 expenses. And again, you're going to use the highest values of those expenses. And you're going to make sure you itemize them so it's very easy for them to follow. And the reason you want to do this is the easier you make their lives and the faster they can get through the audit, the happier they're going to be and the more they're going to want to work with you and work to your advantage. You make it hard for them, and if they can't find something properly, they're just going to disallow it and they're going to say, forget it. Nope. This is too much work. Or if there's a lot of mess, even if they can find it, they're not going to be in a good mood and they may not allow something that's in the gray area. So you really, really want to make their life easy, and you want to be very friendly and nice to them. But at the same time, you also want to hold strong on when you believe you're right in something. You want to make sure that you meet all the assigned deadlines. So they'll always give you a timeline to do something. Make sure you meet that. If there's some reason why you can't meet that timeline, you need to have a valid reason for it, and you need to reach out to them right away before the deadline has come. Okay, and ask for that extension. And if they give you that extension, make sure you meet it. Okay, because if you don't, then they will just say, okay, you didn't give me that, I'll just disallow it. That's fine. That is not something you want them to do, because you will not like the reassessment that's going to come shortly thereafter. The next thing is to really make sure you're communicating smartly. And what I mean by that is that don't give them any information that they didn't ask for. So let's use the example of the top 10 invoices. They asked you for the top 10 invoices. Give them 10. Don't give them all of them. Don't give them 20. Don't give them even 11. Give them what they asked for, and that's it. Okay. And then even the same thing when they're starting to question different things. Don't elaborate. Don't elaborate more than you need to, other than just to justify yourself from a reason that it needs to be accepted. So when they talk about the 10 invoices, even that you're giving them, You don't need to explain, oh yeah, but I did have these other ones. I was going to give them to you because, you know, they were really close in value and there was this, that, but then there was this one that was really weird. So I didn't include it. Like, don't go there. Just give them what they want. Give them stuff that's very simple to follow. Give them stuff very easy to follow that's going to make sense to them so they can move on to that point and move to the next one. Okay. Now, having said that, we did talk about some expenses that are very, very specific to your industry of being allowed. So you do need to be aggressive at certain points in time as to why you believe something is deductible. Use the explanations in that 3 R's slide that I had gone through, showing your reasoning behind why you've done those expenses. So you can be aggressive in your negotiations, but at the same time, still please make sure that you are being respectful, okay? Because respect is what's going to get you to the end of the line in a positive way. So very, very important to always make sure you do that, okay? So I have some final thoughts before we do get into some questions. Really and truly, I know taxes scare a lot of people, but they really, really don't need to be scary. And when you do have a tax bill to pay, it's actually a really good thing because it means you're doing well. It means you've got the income coming in. It means you are doing amazing and you're along the right track. And remember, that tax bill wouldn't be there if you weren't making money. So there was definitely money at some point. You might have just spent it, right? So let's hope you didn't and you put some aside, especially for HST bills. And just be organized and track all your spending to keep as much as you possibly can in your pocket, because at the end of the day, don't forget why you're in business. It's to make money, and so you can also support yourself to live. And I do know that as artists, all of you, it's all in your heart and you do this because you love it. But at the same time, don't forget that you have to make some money at the end of the day too, to sustain yourself and your own living. Okay. So thank you very much, all of you, for listening. I'm happy to take some questions. This is who I am, and I appreciate you all listening and taking the time.
Oh, thank you very much, Kelly. We were really grateful to have you. It was an amazing presentation, and I sometimes find it hard to focus on these workshops. I've hosted, this is I believe my 5th one so far, but this is by far the most I've paid attention to any of these tax workshops. So very grateful for you. Okay, everyone. We've gotten a lot of amazing questions throughout the entire session. We've been filing them into a Google Doc. Nat and I are going to take turns reading out your questions. But if there's anything you want to add on once we say your question, you're welcome to just unmute yourself and expand on that. Again, with the accessibility in mind, I guess just say your name and, if possible, move closer to the mic and make sure that you're able to be heard. So let's get into it. Okay, so first, Lynn says, can you claim equipment bought in a previous year if this is the first year filing as self-employed?
So I guess my first question would be, well, why did you buy the equipment to begin with? So if you were only self-employed this year and you had purchased it, let's say last year or the year before, my question is, what was your intent when you initially purchased it? So if it was for personal reasons, then my initial reaction would be no. But if it was something that you purchased maybe for personal reasons or for future of when you plan to generate income, then that's different. And what you're going to be doing is basically, in essence, when the sole proprietor business started up, you want to value what the current value it would be if you were to go out and buy it today. And what I mean by that is the actual one you have. So in essence, you, the person, is selling it to you, the sole proprietor business. So you're going to value that, and that's the value that you would deduct it at.
Anything to add, Lynn?
Thank you. Yeah, it was it's stuff that I've bought, and now I've always intended to have my own business, but now it's and I never filed as a self-employed, but it's all equipment that I'm going to use for the business that I bought, you know what I mean? And it's been bought over the last few years. So yeah.
Yeah, so if you value it and then take the deduction for it now, you can do that. What I wouldn't do is, if you're HST registered, I would not take any HST write-offs for that.
Okay.
Yeah.
Perfect. Thank you so much.
You're welcome.
Thanks so much, Kelly. Our next question is from R. They're wondering, what are the pros and cons of registering artist as a business with HST, an HST number?
Well, first and foremost, you have to, whether you want to or not, once you get over the 30,000 threshold within that 1 year period, so the 4 rolling quarters, so you don't really have a choice. Where you do have a choice is if you don't reach the 30,000 and you want to register or not. If you had asked me this question a few years ago, I probably would have told you go ahead and register and get the refunds, because if you're in a position where your income is high and your income is low, sorry, and you have a high expense year, then you can get the refunds for the HST side. But I find CRA is just making it a nightmare to get any refunds out of them these days, and they're actually selecting to audit a lot of people who are in those refund positions. But having said that, where it still makes sense is, as I mentioned, that you don't have to take all the deduction for the HST all in 1 year. You can use some of those in future years as a deduction and hold on to them. So this is where it might be beneficial. So in the beginning, you might have a lot of expenses and you're not necessarily having that income to match it, but you know it's coming next year or the year after based on some discussions you had for future contracts. So in those situations, that's when it might make sense to register for the HST earlier so you can take that HST deduction. Because you can't take the HST deduction in future years for stuff that happened before if you weren't registered for HST then.
Great. Anything to add, R? No? Okay.
Lovely. Next up, we've got a question from Alman who asks, what happens if you get paid in USD/Euro/international currencies?
Well, that makes for some fun bookkeeping is what that does. What you need to do is you need to exchange it. So when you're doing your reporting in Canadian dollars, and what you should use is the Bank of Canada rates to do the exchange. So if you look up on the Bank of Canada rates, the exchange rate values on there, they usually have one, a month end one, they have a year end one that you can use on there. And use that rate to convert it. That's what you would report for your income. But keep in mind, if you're HST registered, as I mentioned before, you want to be making sure that you're filling out those 2 separate boxes between like the Canadian source HSTable income and the out of scope income, so that they're matching. So you're not showing anything that's less than what they would expect to see from a reported of collected HST value.
Anything to add? Lovely.
Great. Our next question is from Ruby. They're asking, how does one bill yourself? I received this project grant and it allows me to bill myself as the artist creating the works. I assume I will bill my labor at an hourly rate. How is this recorded on paper/receipt in case of an audit?
Okay, if you're a sole proprietor business, you don't have to do that at all, because every dollar that the company makes, you're reporting the income on, and they just assume you're taking the money no matter what. Whether you actually spend it or whether you actually give it to yourself or do anything, it doesn't matter. It's treated exactly the same way, so you wouldn't do that. Now, if you had incorporated yourself, that's a different story, because now you would do the T4 or the T5, so payroll or dividends to yourself, or if you wanted to report some of that as sole proprietor, then you could invoice yourself as a subcontractor out of the business. But if you're a sole proprietor business, you don't do that at all. It doesn't matter, doesn't make any difference, because you're still reporting the same number. Hopefully that helps.
Great. Next question is from Shannon Lamb. I incorporated in September of last year, so I spent part of the year as self-employed and part of the year as a corporation. Do I include the income before I incorporated on my corporate return or my personal? On this same topic, do I put all of my deductions under the corporation or divide them? Thank you.
Okay, so really, really important is understanding once you've incorporated, that is considered completely separate from you. That corporation is its own entity. There's you, and then there's the corporation. So from the time you would incorporate it in September, everything that happened from that day forward, you're going to report on a corporate income tax return. Everything that happened up to that date, you're going to report on a sole proprietor business. Now, there still could be some crossover in between those periods. And the only crossover is going to happen from September to December. And that's going to be based on if you still continue to finish up another contract under the sole proprietor as opposed to the corporation name. So that's where it can get a little sticky, right? But if you did a very clean cut, you're going up to September for sole proprietor and reporting that on your personal income tax side. And then your corporate filing is going to be from September to December. Now, if you took any money out of the corporation and you gave yourself a T4 or a T5 out of that corporation, then you're going to report that piece as well on your personal income tax, right? For any income you took out of the corporation. Does that clarify for you? I'm happy to take follow-up questions on that to clarify.
I think that helps. Thank you very much.
Okay, great.
Appreciate it.
Thanks, Kelly. Our next question is from Fatima. They're wondering, is it possible to do a combination of employment and self-employment? How would this work for filing?
Absolutely. So the T2125 is an additional schedule that you use on your personal tax return. So your personal tax return is filed the same way as it always would be for any employment income. Even if you didn't have it, you still file it anyway and don't fill out that section of it of employment income. And you would fill out any of your other deductions that you're doing from just your personal reporting standpoint, including investment income and so on and so forth. The T2125 is the added schedule where you're reporting additional income of sole proprietor business.
Thank you.
You're welcome.
Okay, next up, we got a question from Raquel, who asks, I love this role playing. What is defined as employment versus self-employment when you have a T4 from some jobs and then a T4A from creative employment? Or say you have a full-time job, but a Canada Council grant. Under which category do you file?
So the answer is both, but it's all within one tax return. So similar to like I answered on that last question, you're filing your personal income tax return the same way reporting that T4 income. And then your T4A income for your creative side, you're going to show that on the T2125 as your income coming in, any grant income and so on and so forth that you're getting in, you're going to report that on that side. And then you're going to deduct all your expenses, but you'll show all of it still. It's just in different spots of the tax return.
Great. Awesome. Thank you so much. Our next question is from Selena. They're wondering, if I booked a job in 2022 and the job was done in 2022 and they paid me in 2023, should this income be categorized in 2023 for tax purposes? Another question is that my friend paid for equipment I needed for business purposes and I paid her later on. Is this expense tax deductible for me?
So yes, it is. Just now, if she paid for it, who has the receipt? You'll want to make sure you have a receipt for it. So you can justify the expense being done. As long as you have the receipt, you can deduct it. That's not a problem. Now, with respect to the income, there's two different ways that you have a choice to report when it comes to being a sole proprietor business. You can do it on a cash basis or you can do it on an accrual basis. A cash basis would tell you when I receive the money is when I'm going to report the income. So that means if you didn't get paid in 2022 and you got paid in 2023, you're going to report the income in 2023. Now, if you choose to go on an accrual basis, you're going to do it based on when you earn the income. So then you would choose to report it in 2022 and not report it in 2023. I find for sole proprietor businesses, the easiest way to go is to go based on a cash basis. Just follow the money. That's what the bank account, that's what your bank statements are going to show. If you get audited at the end of the day, that's what you're going to be showing them more than anything anyway. And then just make sure if you ever did get audited and they're asking you for a copy of those invoices, because the invoices will show a different year, that you do communicate to them that you report on a cash basis, not an accrual basis.
Okay, thank you so much. So if I choose to report it on a cash basis, I'll just like do it for every jobs I got, right? Like not to jump back and forth between those two.
That's right. That's right.
Right.
Yeah.
And also that you mentioned as long as we have the receipt of the equipment, does that matter that because on the receipt that will have my friend's name instead of my name? Does that matter for that?
In that case, what I would do is have your friend write a letter that you can have to go with the receipt that says that you reimbursed her for the cost of this, that you bought it from her.
Okay, got it. Thank you very much.
You're welcome.
Great. Next question is from Irene, who asks, for freelance income under 30,000 annually, is there anything to pay attention to other than filling a T2124?
Well, it's a T2125, so I want to make sure you get that number right. That's the one you want to fill out. If you're not HST registered and you're under the 30,000, that's totally fine. Really, what you want to just make sure you're paying attention to is all of the earlier slides, making sure you're taking all of those deductions, right? Make sure you're reporting all of your income. If you are doing any work through agents or through business managers or through unions and whatnot, you just want to make sure you're using the gross income numbers, not necessarily what they're giving you in your hand. And that's really important from the income side that some people miss, because there might be some remittances and stuff that are being done on the top end, but you want to make sure your gross income number is being reported correctly. So if for example, you were working with an agent, a business manager, or a union that's doing RSP contributions for you, well, you're not going to see that money, but you actually did earn it, and they're just putting it somewhere else for you. So it's really important that you're making sure you're getting the proper gross income number, and the way to make sure you're doing that is to make sure you're getting summaries from any of those people who are the ones who are paying you. Because if you're with an agent or you're with a business manager or anything along those lines, they should be tracking that for you and providing you the year-end summaries. If you're with a union, they should have something that you can print out showing the income flow of everything that's happened as well. So it's really important just to make sure you know what your numbers are, because it's not always what you see in the bank account.
Yeah, I have additional information on the question. So it was a very, very casual freelance activity, but I only worked for like a singular studio for a short period of time. So I was paid with e-transfer and I was giving the invoices. While filing 2125 T2125 is like, should I indicate the company, like the studio, or is it
No.
not?
You don't have to indicate anything to do with that. All you do is you just fill in the box number where it talks about your income and just put the value in there.
Awesome. Thank you.
Yeah. You're welcome.
Great. Our next question is from Abadar. They're wondering, how do tuition credits and OSAP work on your taxes?
Okay, so with those, there's a section for tuition credits. You have to make sure you have a T2202 from the institution login page that you've got for your own registration. You should be able to download that slip, and it will have an attributable value for the tuition. So that's the amount that you would be able to claim in tuition credits. And if you don't need all of those credits in the year, they can be carried forward for future years, but you do have to include them in there so it can be carried forward. Was there a second part to that question? Did I catch it all?
Got it all. Thank you.
Okay, great.
Sorry, Natalie. Abidar here. I just also had a question about OSAP, and if you're paying your OSAP loan, is it correct that you're only paying or you're claiming just the interest amount on your taxes with the OSAP loan?
So from the OSAP side of things, so there's kind of two pieces to do with this. So if you had received any amounts of OSAP that you do not have to repay, chances are that they're making it where it's non-taxable for you, and that would be shown in a tax slip they would issue you. So you would just make sure that you're reporting based on the way they're giving you the information. When it comes to the interest side of things, so if you're paying interest related to the loan, there is an interest amount. And usually if you have a CRA My Account, you can see that right on your site. It'll tell you the amount that you can deduct for the year that's interest related, and you can take a deduction for that. And there's a spot right in there for student loans and interest payments.
Thank you so much.
You're welcome.
Our next question comes from Julia. Hi, Julia. If I earn money through multiple different avenues, do I need to register different sole proprietorships? Example, music, design, illustration, etc. Or can they all be considered creative services?
So I would say it depends, right? In this situation, I think you could get it all under one, if as long as you can find an NAICS code. So that's NAICS code that will fit all of those activities, then you can put them on one. Now, if it doesn't all fall into one category, then you'll have to file multiple T2125s.
What do you think, Julia? That sound good?
Yeah, that sounds great. Thank you.
You're welcome.
Okay, our next question is from Shannon. I only have clients based in the US, so it's my understanding that I don't need to charge HST or GST. Do I still need to register for an account?
Okay, so this one's kind of an open question because it depends. So just because you're doing business with people in the US doesn't necessarily mean that it will be or wouldn't be HST applicable. It depends on where is the service being provided. So if the service is being provided in Canada, so if you're doing everything in Canada, then this is where it is actually HSTable. But if you're doing something in the US and the service is being provided over there for whatever they're getting, then it wouldn't be HSTable. And it would be considered more on the US side. The one thing I will caution you on this is that all of those items that are not considered HSTable might potentially put you in a position where you might have to be doing a US tax filing, because now you're generating US tax income, you're doing US income. And depending on the amount on there, you might find yourself in a threshold where they want to start taxing you on it as well in the US. There is something where you can file under the treaty and it's exempt and whatnot, but you just want to be careful because US sourced income you're supposed to be reporting in the US, and then any tax you paid in the US, you're supposed to then be taking what's called a foreign tax credit in Canada to offset any taxes you've already paid, so you're not getting double taxed. Because wherever you're considered a resident is where you're going to be reporting your worldwide income. So that one's a bigger question from the specific scenario. It's not really one of those that's a very quick answer. It really will be an in-depth discussion on that one, on your situation.
Thank you. I'm new to Canada. I came in April of last year, and I am normally I'm a US citizen, so I'm filing all the tax returns possible. The person that helped me incorporate said I didn't need to file GST, HST. So I'll have to, looks like, take a closer look at that.
Yeah, just take a quick look based on what it is. Like you just have to be careful because there are specific rules, and it depends on what it is that you're doing too, that the rules can change, right? GST, HST is not very clear cut when you're coming to the border and the specific types of services that are happening. It does change depending on what it is. I mean, there is a very clear answer at the end of the day, but it depends on the specifics around it.
Got it. Okay, thank you.
You're welcome.
There's only about 10 more questions left, so we are almost there.
Okay.
We might even finish early. So Raquel asks, do artists need to pay HST on exhibition fees? Which might need some clarification.
On the exhibition fees, so I'm just trying to think on the exhibition fees. So like there's an event being done and you're charging people to come in the door. Is that what I'm understanding?
No. I don't even know what I mean. Like an exhibition fee, like you had a exhibition at X Space and they paid you.
Oh, so you mean more so like an artist fee, I guess.
Oh yeah, that's what I meant, an artist fee. Thank you.
No problem.
So this is going to, so the answer would be yes if you're HSTable, but it might not necessarily be what they're going to be paying you. So in some situations where you find yourself in this situation, and I've found myself in this one myself, being an HST registered, I'll back into the number. So for example, if it's I will take, if it's $50, I will take $50 and I will divide that by 1.13. So I've come up with an HST component related to that within that $50. So I would do that when it comes to any of your income that's not, you're not getting the HST piece for that you're collecting, if you're not going to be in a position to be able to collect that HST.
And only over 30,000 in 1 year?
No, once you are registered, you must. Doesn't
Oh,
matter if you only make $5 in that year, you're charging HST on that if you have our HST number open. And this is where a lot of people go wrong and get into trouble, because if that HST number is open, you must charge HST. If you don't think you're going to be hitting that number, you can close the HST number. But as long as it remains open, you are required to charge HST no matter what the value is.
thank you.
You're welcome.
Next question is from Alman. They're asking, are there any benefits or credits for low income renters?
So I would say on this one, I mean, for low income renters, you would get what's called on the Ontario Trillium benefit. That's where they're trying to give you back some of it. So you want to make sure when you're filing your tax returns that you're including amounts that you pay towards rent, and they factor in the amount of income that you make, and they help supplement it that way. And you usually get paid either quarterly or monthly, or if it's not much, sometimes they might just give it to you in a 1-year payout, and they'll give you an assessment for it. So I always do recommend that you do make sure you fill out that form and that paperwork on that and give them that information. And the same thing works even if you're not renting and you have a home. If you are in a low income area, you can list the amount that you pay in property tax each year, and that can be used towards that as well.
Amazing. Okay. So next question is also from Irene.
Oh, sorry,
who-
that one was answered previously.
Oh, okay. So I can just skip it?
Yes, thank
Great,
you.
lovely. So again, Lynn asks, is it possible to claim a cash purchase, like buying something like a lens secondhand?
Without a receipt, obviously. And it was
So-
expensive. Yeah.
Without a receipt, the answer is you can, but if you got audited, they probably wouldn't allow you to. If you paid it cash, I wouldn't go there. Now, if you bought it like off of a Kijiji ad or something like that, and you have a copy.
It was through a friend, but it was paid like through like an e-transfer thing. And it was bought through like a reputable friend, but it was like a cash thing. So I can't really say, by the way, that thing you sold me, can I get a receipt for it? You know?
I mean, you have a trail through the e-transfer that you could use. So, I mean, you could through the income tax side, but I definitely wouldn't do it if you're HST registered on the HST side. HST is a lot stickier when it comes to receipts than the income tax side is. Income tax side still wants it in audits, but if you can show through a bank statement that the transfer has gone out and apply that that's what it's gone for, then sometimes if you've got a good agent, they'll let you get away with that.
Okay, thank you so much.
You're welcome.
All right, we just have a few more questions left. This one's from Julia. What's a tax program you would recommend for using for self-filing?
There's a lot of really good ones out there, honestly, and they're pretty cheap. Like UFile, you could use the TurboTax. Like there's nothing wrong with any one of those as long as you have a simple situation and you don't have anything. The one thing to keep in mind is stuff that if you've got stuff going on across the border and whatnot, like that stuff's not going to get captured in there very well, and some of your investment income stuff might not. But for the most part, I find they're really good, and it's a really good interview questionnaire that you can do to go through them.
That's great. Thank you.
You're welcome.
Amazing. Next question, we've got Juan, who asks, how do I file grants? Not the entirety of grants are income, just wanting some clarity about grants in relation to taxes in general.
So from the tax side of things with grants, it's basically, it's pretty simple. You treat it kind of like the way you would everything else. So you've got to report the income coming in, so the amount of the grant that you're receiving, and then you allocate against that income all of the expenses that are being used with respect to that grant. The only difference from the grant that might happen is that if you want to be careful, like if they're giving you tax slips with relation to grants, some grants are non-taxable. So you just want to pay attention to the type of grant they're giving you and what the slip is representing on there. So make sure you understand, is it a taxable grant or is it a non-taxable grant, and that the T-slip they've issued you is reflecting the same information. And usually on the T-slip in the back or at the bottom of the slip, it'll explain what each number and each box number means. So you'll know if it is or isn't.
Great, thank you so much.
You're welcome.
A question from Maya. I'm also wondering about grants, especially if they're only meant to cover material expenses, / they don't create a profit.
So they don't create a profit. So you're saying like your expenses are going to be higher than the grant? If so, that's fine. Same idea. You're going to show the income and then you'll just show more expenses and you'll end up in a loss position.
Maya, if you want to add anything, feel free to hop in.
One thing I want to just kind of note on there for everybody too is we just talked about losses, showing losses. This is one of the areas too when it comes to audits that it's very important to understand is you don't want to be showing a loss on your business schedule for 3 years in a row. Because if you do, that's when they start to question, okay, is this really a viable business or is this just a hobby to you? And if they deem it to be a hobby, then the issue there that comes into play is they'll be like, okay, well, hang on, you've been reporting losses. And as a sole proprietor business, if you had any other income sources, you were able to use that loss to offset some of the other taxes you would have had to pay. So you paid us less taxes. So now we want that money back. So you want to be careful on that standpoint. If you find yourself in that position in year 3 in a row, my suggestion to people is it's better not to take all the expenses. You don't have to include all the expenses. Just show $10 of income, show $5 of income, just so you're not showing that negative amount, because that's when they're going to start to challenge things. And it doesn't mean you can't show losses at a later date in another year. You just don't want to be showing that trend of it happening the 3 years in a row. And you don't want them to see 3 years or more within a 5-year period of it showing at a negative number, because they do look at that, and that's usually how they start to target people when they're doing audits. So you just don't want to find yourself in that unfortunate situation.
Okay, almost there. Next question is again from Abadar. Is corporation the same as having an HST number, or can you
No.
register for an HST number and be a sole proprietor at the same time?
Correct. So HST number is very different than being incorporated. So you can have an HST number as a sole proprietor, and what they do is they issue that HST number to you, the person, not you, the sole proprietor business. Okay, you, the person. So now any income you generate has to have HST on it. If you're incorporated, then the corporation gets the HST number. So similar to like I was saying before, you've got to remember, like when you're incorporated, it's 2 different entities now. There's you, the person, and then there's the corporation. So you, the person, can register for HST, and a corporation can register for HST. So it is different.
And also, Abadar, I noticed that you asked the last question too. So I mean, while you're here, you're welcome to just like ask it if you want, or I can do it.
Thanks, Philip. Sorry, I'm here with a lot of questions. This workshop came at a very opportune time for me. Yeah, this is a bit of a longer question. So I received a one-time project grant. That's a pretty big grant, which is exciting, but also anxiety-inducing for tax purposes. But it's above $40,000. But I know that once I put my expenses to it, it's actually my income for the year will actually be less than 30,000. But given that the grant itself on the T4A will show a huge number in terms of income, should I go ahead and preemptively register for an HST number now?
So this is interesting. So what's going to happen after this grant? Like, are you going to have other income coming in?
I'm gonna have other income coming in, but when I do the calculation of like how much I'm spending from the grant and how much other income I have coming in, it'll still be less than 30,000.
Okay,
But
so
the grant itself is huge.
there's a misconception there. The 30,000 number has nothing to do with your expenses. It's only about your income.
Okay.
So it's not your net income, it's your gross income. So that's important to understand. So once you're over the 30,000 threshold of income coming in, it doesn't matter what expenses you're offsetting on that, you have to register.
So if I have a grant that's over $30,000, I automatically have to register because that grant in full is taxable.
Well, if you have any more income on there, you should be charging HST within the same period, right? Yeah,
Right. Okay. That's very helpful. Thank you.
no problem.
Okay, cool. Thank you so much. Our next question is from Julia. If I was on EI at the beginning of last year and began my self-employment in the middle of the year, how would I include EI information?
So there's a separate section on your personal tax return that you would report your EI income, your EI benefits that you received. It's a separate line item on the main part of the tax return. You should have received a T-slip from the government with respect to the EI you received. So you should have the numbers on there of what you need to report. And then your regular T2125 for your self-employment business income that you're going to be filling out to include the other stuff.
Okay.
But I will warn you in advance, if you had income if you ended up in a profitable situation on the self-employment business side, unfortunately, you're probably going to have a tax bill to pay on some of even that EI money because they probably didn't withhold enough. Sorry.
Okay, I didn't begin working, like I kind of lost a job and was on EI for a few months and then began self-employment like after I stopped receiving EI payments.
Yeah, but how long were you collecting EI for?
I think it was 3 or 4 months.
Yeah, there's potential for a little bit that they probably didn't take off enough tax. Because they automatically, so what tends to happen is when they're giving you money, they only withhold tax, assuming you have no other income sources for the entire year. So they're not factoring in what your true tax bracket is.
Okay. Thank you.
Unfortunately, no problem.
And our last question, it's a pretty long one from Hannah. Hannah, if you're here, do you want to just unmute and ask it?
Sure. Can you hear me?
Yeah.
Yes.
All right. So if I created a sole proprietorship in November of 2022, do I have to submit anything for this tax season? And did you say earlier that a sole proprietorship's business activity is included in our personal taxes, or would that be something I have to submit separately at a separate time?
Okay, so 2 pieces to that. So yes, the sole proprietor income does get reported in your personal tax return on the T2125. And yes, you would need to include any information related to any income or expenses for the months of November and December of 2022 on your personal tax return for 2022.
And would I have to indicate anywhere that like this is my business that I just made, or do I just like it's just all numbers to them?
It's on the 2125. So on the T2125, it'll ask you some specific information that's informational at the top. So it'll ask you if there's a business name, whatever the business name is. If you don't have a business name, you just put your name. Same thing with the address. You can just use your own home address if you don't have a studio or anything like that. And then it'll probably ask you if this is what I think it asks you your start date of when you actually started the business. So you'd put your November date in 2022, and then it'll ask you for what's called an NICS code. And that you should look up, like there's so many of them, like I couldn't even attempt to try to give you what your code is right now. So if you look it up on the government website, you just search NAICS codes, they will give you a full listing of all the various types for the different industries and the different specific type of activity you're doing, and you can include that in there.
And then there was a second part to my question around receiving a grant. If they didn't send me a T4, do I have to claim it? Do I, like, I don't know their business number. Do they care who gave it to me? Should I bother claiming it if I know my expenses or my profit or whatever was under 30,000?
You should still put it in there, even if they didn't give you a slip for it.
And like if they gave it to me via e-transfer, but I don't have a business number for them, just like their name, does it
Yeah,
does
you
it
don't
matter for
need, you don't need their business number in order to claim income. It's
Okay.
really just, you're just following the cash flow.
Okay, okay, that makes a lot more sense. And does that apply to people who I've paid? Like it doesn't matter who they were, I just say I paid this much.
Well, you
Like
need a
to
receipt for that stuff. So on the tax return itself, so keep in mind, there's two different things to think about here. There's the tax return, and then there's what if I get audited later on down the road?
Mhm.
Okay, for the tax return itself, all you need is to provide is numbers and based on categories of types of expenses. Okay, and same thing with the income. It's if you get audited, you need to be able to prove how you got to those numbers. You need to show reasoning and justification as to how you got there. So the income coming in, very simple. You show it through the bank account going in. The expenses, that's where they're going to want the receipts, right? Anything that you're paying out, they'll want to see a receipt or an invoice that you had to pay. So
Right.
that's the part that you need to have in case you ever get audited.
And if I have all those e-transfer slips, like would it screw over the other person if they didn't claim it, but I'm showing like I fully did pay you? I was just figuring I wouldn't say anything about it so they don't get in trouble because I thought I'd have to say their name.
So the answer to that is if you got audited and they looked at it, they could.
Screw
They
over the
could,
other
and I'll
person.
tell you right now, that's how they find some people is they'll start auditing somebody and then they'll come across something and then they'll decide to all of a sudden random audit this other person because they've seen stuff.
Wow. Okay, you need to do a whole other workshop on tax fraud, but for now, this makes sense to me, and I'll just report honestly then. Makes sense. Thank you.
Yeah, like report honestly and stuff, and keep in mind too, like if ever that were to happen, your name would never come up on it. You're doing the right
Oh,
thing that
that's
you're supposed to be
awful.
reporting. I know, I'm saying your name wouldn't, like you wouldn't be called out on it, is what
Okay.
I'm saying. Like you would never be known that that's the way they found out, that they chose to do that. You would never know. But really, it's everybody's responsibility to be reporting their income and expenses correctly and fairly in the way it should be. So if you're doing what you're supposed to do, you can't control what other people are doing. And it's really not, but this is where the receipt comes in, right?
All right.
So if there's a flow, if there's e-transfers going on, there's a paper trail, right, of stuff starting to move around. So if somebody was planning not to report something, usually they do cash because then there's no trail.
Right. Okay.
But just to set the record straight, I am not approving cash transactions.
Okay, no, I'm gonna go message all my business partners and tell them to go do their taxes properly. Okay, thank you.
You're welcome.
Well,
Woo, taxes, am I right, guys?
thank you so much, Kelly. We really appreciate your time and sharing all of your knowledge with us. It was super helpful and eye-opening, and I'm ready to do my taxes.
Great.
Yeah.
Well, you're very welcome. You're very welcome. And feel free, everybody, to use our website, rosspc.ca, to find out info. I try to post things as much as I can. Use our tax packages that are in there, which will give you ideas of the different expense types that we went through and stuff as you're working through your stuff. And follow our Facebook, Instagram, or LinkedIn accounts. I try to do posts on there that I think are relevant when new topics come up, so everybody can stay in the know. And good luck this tax season, everyone, and thanks for listening.
Thank you.
Thanks, guys.
Bye, everyone.